Legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of such. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Of opportunity for those who want to do their homework and look in the equity market.
I think there's opportunities in things that aren't so obvious to people because they are more economically sensitive.
The income side of the economy is what has me most concerned. It's not a reason to panic, but it's a reason to understand why consumers are going to be more prudent.
The outlook for retail for the rest of 2024 may not be so strong.
Subsurface activity down the cap spectrum, you have started to see more improvement, and I think that's a healthy thing for the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell. The third hour of Bloomberg Surveillance starts right now. Let's kick it off with the scores on the S&P 500, negative by 0.4%. On the Nasdaq, we're down by 0.7. On the Russell, the small caps off by 0.5. Adding to yesterday's losses, the S&P 500 with its biggest one-day drop since August 5th. On the Nasdaq 100, its biggest one-day drop since July 24th. The week ahead, Been through this a few times. Here it is again. It concludes with payrolls Friday. The median estimate in our survey, around 160,000 jobs for the month of August. Later on today, we get the JOLTS job openings data. That comes at 10 a.m. Eastern Time. Durable goods and the Fed's beige book a little later on this afternoon. More signs of consumer weakness earlier on today. This time it's Dollar Tree cutting the outlook. Consumer difficulties, the stock getting absolutely hammered. And Anne-Marie, we saw exactly the same thing with Dollar General about a week ago.
Yeah, it's showing that this consumer is struggling to maintain higher inflation, higher interest rates. What's also interesting is that these stores are the ones that are supposed to do well in this environment. And why aren't they? Look at the mass competition that's come in from places like Walmart that actually says the higher-end consumer is trading down. Places like Aldi, they're offering, they're price cutting, and they are a real competitor now, and that's just clearly weighing on these companies.
Mentioned this quote from Dollar General a few times in the last week, mentioned it in the previous hour as well. I think it's worth going over again. Dollar Tree with its own difficulties down 11%, but certainly seeing the same story. Dollar General in the last week, in what I think was maybe the quote of August from corporate America on low-income shoppers, inflation has continued to negatively impact these households, with more than 60% claiming they've had to sacrifice on purchasing basic necessities. When we talk about the inflation story being mission accomplished potentially at the Federal Reserve, for Main Street America, it's anything but. And you can see it in these numbers repeatedly.
This is what Raphael Bostic continues to say. We're getting closer to our target. Potentially we're not there. His concern has always been cutting and then seeing they didn't kill the inflation drag and then they need to hike again. He doesn't want to do this whipsaw, which is why it's interesting when people come on and say, potentially we'll get 50. How do you get someone like Raphael Bostic to 50 when he still has concerns about some of this inflationary pressures?
Still using the words like gradual and methodical on repeat. Equities right now on the S&P 500, negative then by 0.4. Just to touch base with the bond market, the rally continues. Yields are lower once again on a 10-year down to 381. We're down about 2 basis points on the session. The euro not doing much. Euro dollar 110.49. Crude bouncing by 0.8%, $70.88. Brent crude rallying as well. Just a story that dropped in the last few hours. A conversation now around whether OPEC has to pull back on this increase in supply that was due to happen later this year.
Because they probably want to protect prices, and also they now are going to have potentially a deal in place with the Western Eastern governments of Libya. Means more Libyan market oil will come to market. So why does OPEC have to add? Also, they are basically fighting the United States. They are fighting more than 13 million barrels a day from the U.S. This is something that they didn't always have to contend with.
Brent crude 74.14. Coming up this hour, here's your lineup. Laurie Heinel of State Street as the global tech sell-off continues. Lisa is at the Goldman Sachs Retail Conference. She'll be catching up with the on-holding co-CEOs Martin Hoffman and Mark Mora as the footwear brand ramps up international expansion, and Walmart Senior VP Manish Juneja on a new e-commerce lineup. All of that still to come through the next 55 minutes or so. Let's kick it off with our top story. Another month begins with another sell-off. Stocks posting their worst day since the early August meltdown as traders brace for more U.S. data. Laurie Heinel of State Street writing, in the U.S., economic activity has proven resilient, but we're seeing meaningful signs of a slowdown. More focus is on the labor market now, and we're watching for signs that would indicate more concerning deterioration. Laurie joins us now for more. Laurie, welcome back to the program. Let's start with your quote. Meaningful signs of a slowdown. Where do you see those signs currently?
Well, certainly we saw some of that in the labor market reports, and the underlying weakness that we're seeing come through there is certainly something that's been concerning. But we've been on the hunt for a while for the Fed to get started with its rate cutting. We actually think that rates at the current levels are too restrictive given the slowdown in activity that we have seen this year.
Are you leaning back out then of U.S. equities? What are you doing with your exposure to U.S. stocks?
Yeah, so we have definitely paired our exposure to stocks overall, not just in the U.S., but if you look outside the U.S., China has been slowing. Eurozone looks really challenged at this point in time. So we do maintain a slight overweight to equities versus where we were earlier this year, but it's much more concentrated in large cap U.S. in particular, with a little bit of fringe exposure in EM where we think valuations look pretty attractive.
Laurie, where is the rest of the world right now? We're having this big conversation around the story at the Federal Reserve. Will interest rates normalize? At the same time, we're trying to work out whether growth differentials can rebalance as well, because growth differentials have been very, very wide, as you know. US great, Europe struggled, China struggles. Do you think we can close the gap in the months to come, or do Europe and China have their own difficulties?
Well, it's very idiosyncratic. I mean, certainly in Europe, they've already started to cut rates, and we think there's room for them to cut further there. The problem there is that you have a lot more pressure from the geopolitical risks that are burdening Europe. You also have a little bit mix in the sectors, which is not flattering. So some of the more pro-cyclical kinds of sectors are more well represented in Europe. So that's an area that we've been quite cautious on, despite the fact that it looks relatively attractive. And then you look at the U.S., and there are still lots of tailwinds. So we think the consumer is a bit challenged, as we've talked about, but there are places like government spending continues to prop up some of the U.S. markets. And you do still have a lot of the key industries and technology that are dominant here in the U.S.
Lori, when you say the consumer is challenged, do you mean across the board, or are you really just seeing this in the lower end?
Well, it's primarily in the lower end at this point in time. And of course, we've seen things like stock market valuations and housing increases really benefit disproportionately at the upper end. But some of the things that are starting to concern us are broader scale layoffs. We're starting to see announcements of companies that are employing, largely white collar, relatively higher compensated employees. That's an area that we're going to be watching very carefully, because at this point in time, that upper end is not challenged, but that doesn't mean it couldn't become so.
We know that the Fed is now focused on the labor portion of their dual mandate. You say why we believe a 50 basis point cut is warranted by the underlying healthy economy. Explain those reasons. We think the Fed is more likely to cut 25 basis points. What do you think they need to see Friday to move to 50?
Well, I think there's very little that could move them to 50 in September, despite the fact that we think that that's warranted. They've been signaling all along that they're going to be very data dependent. They've been signaling all along that they're going to be measured. They definitely have the inflation boogeyman in their sights still. So I think it's more likely that what we'll see is a 25 basis point cut, but a bit more forward guidance around how they're seeing this evolve and what might cause them to actually get more aggressive.
When it comes to the data on Friday, when you look at it, do you take it with a grain of salt, given the massive revisions we recently saw?
Well, that's been the big story that we've been talking about all year that I think is starting to finally get a little bit more attention. The fact that at the time when central bankers are focused so much on the coincident data, that data has been very volatile and subject to lots of revisions. And we saw that in the labor reports that came out that actually led to market weakness in August. So it is a sort of a conundrum for them right now, but they have committed to that, and we think they're going to stick with that. But they will look through that, and I think the fact that they're broadening out to look at things like labor markets instead of, or just not just inflation, is very healthy from that standpoint.
Lori, it's difficult. We've asked this question a few times already this week, whether we should just ignore headline payrolls on Friday or just subtract 60 to 70,000. I even had a question yesterday, and I'd love your thoughts on this too, whether we should place more weight on the ADP, because maybe the ADP report gives us a better read of things. We had a guest earlier this morning that said ignore jobs, job openings, focus on the beige book later on this afternoon. Lori, how much weight do you put on one report versus the other this week?
Well, we actually would agree with you completely. You have to look much more broadly, because it's not even just the headline number, but what's underneath the surface. What are we seeing in terms of hours worked, for example? We're also hearing more and more that employees are getting a little bit of pricing power, that they don't have to necessarily pay up to get that incremental employee. So it's not just about the headline number, but look at the detail, see what else is out there and where there might actually be weakness that the Fed will be responsive to.
Lori, thank you. Big week ahead. Lori Heinel there of State Street on the latest. Let's give you an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Volvo Cars is walking back its target to go fully electric by 2030. It's just the latest manufacturer to rein in its EV ambitions on waning demand. Instead, Volvo will aim for 90 to 100% of its sales to be a mix of both fully electric and hybrid cars by the end of the decade. The company said it still plans to become a fully electric car company longer term. Dick's Sporting Goods delivered better than estimated second quarter results and raised its full-year forecast for sales and earnings, still falling 1.3% in the pre-market. The report does suggest the sporting goods store is sidestepping widespread consumer caution that hurt other company chains. The company expects comparable store sales, a key retail metric, to rise 2.5% to 3.5% in 2024. That is up from a previous forecast that topped out at a 3% gain. NVIDIA CEO Jensen Huang's wealth tumbled the most ever after routing chip stocks yesterday. Huang's net worth slumped about $10 billion to $94.9 billion on Tuesday, the biggest single-day drop for him since the Bloomberg Billionaire Index began tracking his wealth in 2016. The plunge followed a 9.5% drop in the shares of the chip maker he co-founded. And that's your brief, John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the programme, the Morning Calls Plus, on holding co-CEOs Martin Hoffman and Mark Mora as the brand looks to continue gaining market share in the footwear space. We'll cross over to Lisa at the Goldman Sachs Retail Conference in just a moment. From New York this morning, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
One hour and 16 minutes away from the cash open. Futures pulling back by 0.4%. Yields a little bit lower by a basis point. The 10-year 381.96. Time now for some morning calls. First up, TD Cowen upgrading Sweet Green to a buy with a $43 price target. The analysts seeing strength this year, driving more upside in 2025 than consensus estimates. They've got to do better on portions. Terrible. The protein portions, you notice that? Like 4 bits of chicken.
A little bit of a scoop. Yeah, they need to up it up.
Figure it out. Sweet Green up by 2%. That's probably why. Next up, Barclays downgrading Supermicro to equal weight with a $4.38 price target. The analyst taking a more cautious view following poor gross margin in the June quarter and an annual filing delay. The stock is down by another 2.9%. And finally, B of A double upgrading Nasdaq to buy from underperform with a $90 price target. The analyst forecasting a rebound in IPOs following the US presidential election, which will benefit the company's listing business. Nasdaq is up by about 1%. Let's head back to Lisa on the ground at the Goldman Sachs Global Retailing Conference with the consumer very much in focus this morning. Morning, Bramo.
Hey, good morning, John. Honestly, to me, the big question for everybody, I'm sure on Wall Street as well as here, is just what is the state of the U.S. consumer? The state of the U.S. consumer when it comes to running shoes, at least for on holding, is very strong, at least based on ongoing demand. But there's a real question here about market share and how do you grow a company this much with some 70% gain in the shares just this year alone at a time where the likes of Nike are seeing a decline of 24%. I'm so pleased to say joining us now are the co-CEOs and godfather of each other's children. We have Martin Hoffman as well as Mark Mora. So I want to start with this question of how do you sort of establish yourself in the running category that's highly competitive where you're also seeing declines elsewhere?
So the mission of the company is to igniting the human spirit through movement. And we started in running. We broke out into many other categories like tennis, like outdoors, training, but also lifestyle. And we want to be the most premium performance sportswear brand. And so we live at that intersection of performance and design. So we speak to a customer that wants to win a marathon. We speak to the everyday runner, but we also speak to the one who loves to move in the product. And I think growing in the premium category is really strong. And to your question on the consumer demand, I mean, we had an amazing summer. We had so many highlights from Paris to the launch with Zendaya, and we had over $1 billion in sales in the first half of the year with 30% growth. So we couldn't be happier with where we are.
So I can just say that, you know, Roger Federer joined with you, you know this, in 2018, I believe, owning 3% of the company. You IPO'd in 2021, and it was kind of a slow start. What catalyzed the sort of surge that we've seen so far this year?
So I don't think we had a slow start. We grew consistently by 70% almost over the last couple of years, including the IPO. And I think since the IPO, we've been very focused on executing on our strategy, which was, you know, we wanted to increase the footprint that we had in the US. It was important to start to get into own retail. We wanted to grow apparel. It was important for us to continue to gain share in Asia and in China. And I think we've executed on all of these points. And we knew we need to transition from a phase of hyper growth into a phase of what we call more durable growth. So this is more in the 25 to 30% range. And I think this is exactly the journey we're on. This is what's happening this year. The nice thing is we're at the size now where that still means we're winning a lot of incremental new consumers, and we can give them access to on products, to on apparel, to on footwear. And I think we're quite happy since the IPO on the journey that we're on.
You're a Zurich-based company, but the bulk of the growth has been in the US and in North and South America. How do you see that evolving over time? I mean, is that basically the biggest growth area going forward, or is really China the biggest growth area?
I mean, the US is our most important market, and we make about 65% of sales in the Americas region. At the same time, Asia is the fastest growing market, including China, Japan, Australia. So I think being born in Switzerland, we became a global company very early on. And this helps us because we have so many pillars of growth all around the world that we can execute on. And yeah, I think that's a unique position.
You know, I talked about Nike, and they kind of grew up in tandem with Michael Jordan and his star power. You not grew up, but you rode in tandem with Roger Federer. You have the Rogers in terms of shoes. Now you're bringing on Zendaya. She's not a sports star. What sort of does this represent about the shift in how you're trying to target specific influencers in a world that some people are saying the barrier to entry is not lower, but different in terms of potential disruptors based on social media, et cetera?
I mean, Martin said it in the very beginning, we're about igniting the human spirit through movement, right? And so for us, the question was, how can we credibly tap into many different communities and excite them to move? And Roger was absolutely essential to tap into the tennis community, to start to build tennis together, and also make the company known to more and more people, right? Because of obviously the awareness that he has and how he was helping on to reach a larger audience. And with Zendaya, we spotted her wearing the product. And she was wearing the product moving, you know, she wasn't wearing the product just standing around. And so a discussion started, and it was very important for her that more people can get access to movement and that she can shape a little bit the messaging that's happening there and the products that these people are wearing. So that really allowed us to start to work with her on apparel collections, on footwear collections. She's wearing the Cloud Tilt a lot. She has her own apparel line. We're going to see more of that. And so that allows her to bring now that collection to her community. And so On is very much about the end. And this is also what you saw in the air tennis video. Roger couldn't play air tennis by himself, nor could Zendaya do that. And for us to bring both, you know, characters together and individuals together is a huge dream, and we're very, very happy that we can bring that to the world.
How do you sort of see the strategy evolving? One thing that I've been talking with a lot of people this morning is this question around direct-to-consumer, which was, you know, a focus of Nike's, and I hate to keep mentioning them, but, you know, this is sort of the parallel that some people are drawing, and this need to do both, right? This idea to emphasize stores, but also direct-to-consumer, and also website. I mean, how do you sort of navigate that? How does that evolve based on where you are now?
Yeah, we absolutely believe in the power of the multi-channel distribution network. And we started with Run Specialty. They are still a super important partner for us. And because that combination of wholesale partners and our own direct-to-consumer channels, they allow us to reach much more customers in a shorter amount of time. And a few years ago, we started to build our own retail network with the first store here in New York. Now we have 25 stores outside of China, same amount in China. And that channel is performing incredibly well for us as well, and including super high apparel share, so very important on bringing apparel up as an important category for On. So we really see that this combination of the reach of wholesale partners and then being able to connect more closer with the customers through our D2C channels is a very important combination and success factor for On.
You talk about China. There's a lot of concern about what the landscape is going to look like for non-Chinese companies in the mainland, particularly as we don't really know where leadership is going and where the moods are going and where tariffs are going. I mean, how are you navigating that at a time where you're trying to expand?
Yeah, for us, it's about bringing the experience of movement to the consumer, right? And I think this is really what we're focused on. So we have a largely local team. So there's very few actually Swiss or Western people in China scaling the brand. We're focusing on building stores in China, touching the consumers through our digital channels. We're focusing on having the right product available, and it's working out. So we're growing very, very strongly in China. We're very happy. It's together with Japan, our fastest growing market. And I think, you know, the On story and what we've built in the other markets shows that in China we're still very much behind on an adoption curve from a market penetration, and we still feel, hey, there's so much leeway to grow, and how consumer demand is exactly working out in China isn't even that important for us because we're still comparably small. And so I think we're quite positive on how we can look at the near future, and we're also very positive that we can navigate more political topics.
Who do you see as your biggest competitor right now?
I think if you look into our history, we have almost created the market that we are in today, so that premium performance sportswear market. And so I think for us, it's much more of opening up more market opportunities. Take our collaborations with Loewe, for example, where we also open up new price points for our brand. So we focus on ourselves, and really the core is in innovation. So in Paris, we announced Light Spray, which we think has the potential to really revolutionize the running industry, how a product looks, how a product is manufactured, and how you come up to the next level of sustainability. So we are focused on ourselves.
Do you guys go for runs in the morning together?
A lot.
Really?
Yeah, I mean, not so much together actually, because Martin is way faster now. Not so much together, but running and movement is a very important part of our culture. So I think it really helps us to move while we're thinking through problems, and I think it helps us to come up with better solutions. And it's not just us doing it, it's a big part of what the company is doing. And we also did a run this morning with many of the investors at 6 a.m. and so we're helping them to have a good start into the day.
Just real quick here, what's your sense going forward of what that biggest problem would be for this year as you think through it every morning in your runs?
I think the fun part really of our job is to be able to scale and to think about what's the right speed for the company, what do we need to do next to bring the company to the next level. You know, sometimes it still feels like we are acting in a 500 million company, but we want to be a 3.5 billion company, and that's the fun part. And this is also what we talk a lot with the team about: embrace the challenge, embrace the uncertainty, and that everything is a little bit chaotic. But I think that makes up the fun.
Martin, thank you so much for being with us. Really appreciate it. And John, I have to say, as I was eating my bagel, I came in this morning and saw them all, gathered together after their run, and it felt very different. Anyway,
Lisa, are you trying to get invited on a run with the team at On?
Maybe. I don't know. It might have been better, but it was a little too late.
Lisa, looking forward to the coverage a little bit later. Lisa at the Goldman Sachs Global Retailing Conference, joining us again in about 20 minutes' time when she'll catch up with an executive from Walmart. Look out for that. Coming up next on this program, we'll look ahead to the week ahead with payrolls on Friday. Stephanie Roth of Wolf Research and Amanda Lynham of BlackRock still to come. And later, the Walmart Senior VP, Manish Juneja. From New York City, this is Bloomberg.
what's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the opening bow. Equities pulling back by 0.4%. In the NASDAQ, we look like this. We're down by 0.7. On a Russell, we're down by 0.5. The pullback continues. It's almost like a repeat of a month ago. The nervousness started with the ISM manufacturing number, kicked in again yesterday. Look, we said this a little bit earlier. I don't think you can point to any one thing for a reason for the sell-off, the magnitude of the move lower that we got across the board yesterday on the S&P 500, on the NASDAQ, on elsewhere. But it continues this morning. If you switch at the board, you see it as well in the bond market. The rally continues in treasuries. Yields lower by almost a basis point. A 2-year, we give just a little bit of that up at 385.70. And in foreign exchange, just a classic risk-off move in yesterday's session. The only thing stronger against the dollar, the yen, and the Swissy. The yen stronger again this morning, 145 on dollar yen. We're negative by 0.2%. Under surveillance this morning, some top stories for you. Nvidia suffering a record $279 billion rout, the biggest loss of value ever for a US stock, thanks to fresh worries over the AI frenzy. This, as the DOJ slaps the chip maker with an antitrust subpoena over its market dominance. So the pain for this name continues.
That's right. And this is actually a Bloomberg scoop yesterday, Jonathan. We know that the company was given a questionnaire, but now it's a subpoena. So basically, that sets up the showdown that the DOJ stepped closer to a formal complaint on NVIDIA. Their concern is basically they just have too much market share. But we talked to Mandeep Singh. Where else really are customers supposed to go?
Where can they go? What are the alternatives? That is why this name has been doing so well. We'll hear more about those complaints, no doubt, over the next several weeks or so. We'll hear more about this, too, on a campaign trail. This story, the standout one for us this morning. Nippon Steel saying it will appoint a majority American board if its takeover of U.S. Steel is approved. The Japanese steel giant extending an olive branch to U.S. lawmakers who have opposed the deal, including both presidential candidates Donald Trump and Kamala Harris. U.S. Steel saying that if this does not go through, then they might have to shut plants and they might have to move out of Pittsburgh.
If that's the case, then is there going to be a new reaction from, say, Kamala Harris or Donald Trump? The debate is next week. It is going to be in Pennsylvania. And what does every single political analyst come on this show and say? That is going to be the end-all to be-all to this election. The Wall Street Journal editorial board this morning takes no qualms, is going after everyone, the right and the left, and says a politician with U.S. national interest in mind would celebrate the Nippon Steel deal, which would boost U.S. manufacturing, which is basically what the CEO is saying. And he's saying, if I don't get this cash infusion, I'm going to have to close factories and I'm going to have to lose jobs.
How will they respond to that in the campaign trail in the next week? Especially, and you've said this repeatedly through this morning, Pennsylvania is a big, big state in this election, but it's also hosting the debate between Harris and Trump a week yesterday. Elsewhere, beyond the tech route, traders also keeping an eye on this week's U.S. eco data, including JOLTS, jobless claims, and August payroll. Stephanie Roth of Wolfe Research anticipated 175,000 jobs were added last month, and for unemployment to come in line at 4.2%. Stephanie, I'm pleased to say, is back with us. Stephanie, first of all, welcome back. Second of all, congratulations on your little baby girl. We're looking forward to more conversations with you in the future. So thanks for racing back for Payrolls Friday. We appreciate it. Let's talk about payrolls first, Stephanie. Let's get to it. Payrolls on Friday, the median estimate in our survey around 165,000. We've already heard from the Fed chair, Chairman Powell in Jackson Hole, that he does not welcome any further deterioration in this jobs market. What is further calling further deterioration in this jobs market? How would we define that on Friday?
I think that would be another payrolls print that's sub 150,000. I think that would be the unemployment rate potentially rising up to 4.4%. Again, not our call, but if we continue to just see more signs of softness, our base case is that a lot of the softness that we saw in the month of July was driven by Hurricane Beryl. And we'll see a 37,000 rebound from the state of Texas, in which case our payrolls print will be above 150,000, which we kind of view as trend. So if we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market. But our base case is the print should come in pretty solid.
Even if we get 150, given the revisions we saw over the previous year, why shouldn't I just chop off 60, 70,000 off that number on Friday?
Well, I think the revisions might be a little bit overstated, right? So we initially had the numbers that came in, and then it was revised down because of unemployment insurance records. And it's actually possible the revisions won't be quite as large once we get the final numbers, because immigration has been playing a role here, and it's possible that's not necessarily getting counted in the unemployment insurance. So basically, it's a lot of noise to say. I wouldn't necessarily chop off 60 to 70,000. Maybe you can chop off 30 to 40,000, but then you're still looking at a labor market that's still growing jobs and an economy that's doing okay. And by the way, consumer spending is growing about 3% in real terms.
Slowing, so not slow. I'd also love to get your take on what happened yesterday with the ISM manufacturing. We just had Andrew Hollenhorst publish a report saying a fifth consecutive sub-50 ISM reading shows the manufacturing sector is in a sustained contraction. Do you foresee that through the end of the year?
The ISM has been weak for a long time. It hasn't been a great measure of what's happening in terms of the broad economy. And by the way, measures of sentiment, which is effectively what a PMI is, it's asking purchasing managers, how are conditions this month versus last month. Same with consumer confidence. That would have told you we were in a recession for all of last year. So I wouldn't necessarily take that as an indication of where actual broad growth is for the economy. That said, the manufacturing sector has been hurt by elevated rates, and we've seen a cyclical slowdown in a lot of parts of rate-sensitive aspects of the economy. We might see that for the next quarter or so, but now that rates have come down, we should start to see a rebound in the manufacturing sector. I wouldn't necessarily anticipate that in Q3. I think Q4 and heading into next year, especially as we get certainty from a political perspective, I think there might be, and they mentioned this in the report yesterday, there might be some hesitation to invest just because we don't know what the political landscape will be, especially from a tax perspective. But our base case is Q4 into Q1, you'll start to see a rebound in the manufacturing sector, and the cyclical parts of the economy will start to pick up.
So basically, are parts of the economy just on hold until after November 5th?
I think that's fair. Well, at least on the cyclical side and the business investment side. There have been some questions about whether the consumers are waiting to see the result of the election. I don't think so. I think the consumer, and we certainly saw that with Q2 GDP, the consumer is continuing to spend in real terms. Certainly goods spending has picked up a little bit. Services spending has been fairly solid, albeit a little slower. But I think it's fair to say on the capital spending side, there are a lot of companies that are just in hold mode. And then once they see the results of the election, realistically, probably either way, they'll be able to start investing again. And they'll have a greater sense in terms of what the investing landscape will be next year.
Stephanie, we've got to leave it there. It's good to have you back. The brilliant Stephanie Roth of Wolf Research on the latest on the jobs market, looking ahead to Friday and beyond. With us around the table, Amanda Lynham of BlackRock. Amanda, good morning to you. It's good to see you.
Thank you for having me.
Let's get to this credit market. How sensitive has this credit market been to the growth scare of the last 4 weeks?
It's been incredibly sensitive, and I think you can see it both in the widening that happened during the early part of August and the very swift snap back. And I think what that shows you is that the credit market is sensitive to the growth backdrop, especially high yield and leveraged loan issuers in the credit market, not just the cost of capital and the interest rate environment. Starting trading yesterday morning, we had retraced the entirety of the early August widening. We saw almost a record day of new issue supply yesterday in the corporate credit market, so spreads have gapped out a little bit wider than that, but we're still in this kind of narrow range. We're seeing widening get bought by investors. I think the key for credit investors is that, one, yes, the forward path of monetary policy matters, but the reasons behind that rate cut really matter. And then two, we don't need really strong growth in credit to remain resilient. We just need trend or slightly above trend. And I think there's really a wide chasm between a recessionary outcome and the current pace of above trend or slightly above trend growth. And we live in that space in between.
You noted the recent round trip. How symmetrical was the widening versus the tightening beneath the surface? What led and what lagged?
So actually, a kind of higher beta cyclical sectors led the tightening, but it wasn't uniform. For example, triple Cs are still underperforming the overall broader index tightening. But this has been almost a low quality rally in that high yield and leverage loans have been outperforming their investment grade peers over the past few months. That's continued the year-to-date trend. And so for all of the talk about concerns about downside risks, I think investors are making the calculus that are saying, okay, I'm entering at pretty attractive all-in yields. Growth is slowing, but it's not slow. And therefore, the outcome for corporate credit investors can be quite resilient in that backdrop.
What are you personally advocating for?
Yeah, so I think there have been a couple asset allocation shifts that have been super relevant. The first and foremost has been the trade-off between high yield and leverage loans. For most of this year, that equation was very clearly in favor of leverage loans because of the rate backdrop. I think it's now shifted more neutral between high yield and leverage loans. That's one. Two, the recent volatility has showed us how quickly the market can change. That's especially true for the borrowers that may have found that they were locked out of the market even just for a short period of time. So I think we've seen more interest from investors on kind of private capital, something that's not at the whim of the public market volatility. And then three, I still like moving down in quality within the investment grade spectrum. I think one of the key developments since the pandemic is that cliff between downgraded from IG to high yield isn't as severe as maybe we would have thought several months ago. And so if you can own BBB rated firms that have a strong incentive to stay investment grade, and even if they do fall to high yield, will likely be supported and bought, I actually like that. So I think within IG, moving down in quality makes a lot of sense. Within high yield, I would not go all the way down in quality to that triple C cohort because they've lagged.
When you say the corporate credit reaction to the cuts is more important, aka normalization or easing, because they're actually seeing the deterioration in the economy, that scenario is not reflected right now in valuations. What would it take for that scenario to be reflected?
You're exactly right. I think 316 is where we are on the high yield index. That's nowhere near even the post-financial crisis average. So what we are baking in at the moment is truly a pretty benign outcome for credit. I think, as Stephanie mentioned, you would need to see deterioration in the labor market, the growth backdrop that is consistent with the weakness that we saw in July, such that it kind of spooks credit investors that growth is not even at trend, but actually meaningfully below. That's really the critical factor. But again, so long as we have trend growth, companies have shown that they've had an ability to navigate this cost of capital environment. And so really, it's an extreme downside risk to growth. Now, I think the important thing for investors, though, is there is a lot of room for spreads to widen. In such a scenario where we're kind of nearing kind of not recessionary levels, but a sharp slowdown, I think you could see spreads go to 550, 600 from 316. So there's a lot of room to widen.
You've got your finger on the pulse of this market. I think an interesting question for Friday would be how sensitive this market would be to stronger than expected data versus weaker than expected data. What would generate the larger move?
I think weaker than expected data because it feels to me like stronger than expected data is almost priced in at the moment. I realize that GDP can be revised and third quarter's tracking at 2%. So I would say that's not extremely above trend, but we've had resilient growth all year. And I think the consumer has surprised to the upside in terms of spending, albeit bifurcated.
Just quickly, on supply, you mentioned it. The amount of supply we've had in the last 24 hours, the announcement of companies bringing debt to market. Are they operating from a position of strength or weakness or stress?
A position of proactivity and strength. And Stephanie had mentioned kind of capital spending slowing, but capital management has not slowed. And so companies, I think, are being proactive in terms of capital management and the balance sheet as they move towards later in the year in the event risk.
A clinic, as always. It's good to see you. Thank you. Amanda Liner of BlackRock with the latest in the credit market ahead of that jobs number on Friday and the Federal Reserve decision on September 18th. That meeting starts on September 17th. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Nordstrom family has offered to buy the Nordstrom department chain. In a statement filed moments ago, the family would offer $23 per share. That is a 0.8% premium to Tuesday's close. The U.S. department store chains, multiple of them, have been suffering as consumers increasingly buy direct or online. Deal-making has been seen as one of the potential solutions to the industry's woes. Nordstrom earnings last month were better than expected, though, thanks to its discount rack chain. U.S. mortgage rates fell to their lowest level since April 2023. According to data released by the Mortgage Bankers Association last week, the contract rate on a 30-year fixed mortgage dropped to 6.43%. That's the fifth consecutive weekly decline. The drop spurred a pickup in MBA's index of home purchase applications, which rose 3.3%. In the U.S. Open semifinals, it'll be an all-American face-off. In the men's tournament, after Taylor Fritz upset Alexander Zverev, Fritz is headed to his first ever semifinal where he'll take on Francis Tiafoe, which last reached the round in 2022. In the women's tournament, Audrina Sabalenka defeated the Olympic gold medalist in singles and will be taking on American Emma Navarro for a spot in the final. And that's your brief, John.
Very, very cool. I need to check the prices of Tiafoe Fritz. I imagine no one can afford it. It's just ridiculous.
You also need to check whether or not you can get a car into the US Open to take you home.
That is a very, very different thing that we can talk about another time. It's personal. Up next on the program, setting you up for the day ahead. Plus, we'll head back to the Goldman Sachs Global Retailing Conference with Lisa standing by with Walmart's Senior VP, Manish Joneja. That's up next. This is Bloomberg.
The Vivian Tom clientele. Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
.44 minutes away from the cash open. Equities pulling back by a third of 1% on the S&P 500. Giving up some of the rally in the bond market, the 10-year now just about unchanged. Your yield 383.10. Let's head back to Lisa now at the Goldman Sachs Global Retailing Conference. Hey, Bramo.
Hey, how's it going, John? Honestly, this is one of the conversations that I've been looking forward to for quite a while, since we talk all the time about how essentially the big are getting bigger, and Walmart and Amazon are very much dominating the landscape in terms of sales and accumulating market share. And a big part of that has been the e-commerce site, as well as some of the new businesses that Walmart has been charting into. Key among them is the U.S. marketplace, as well as, of course, fulfillment, just the idea of getting packages out. And the person who heads both of those is with us right now. Manish Joneja, who is here in New York City from the West Coast, actually from Bensonville. I'm curious just to start with this idea. We've seen e-commerce, fulfillment, Walmart really transform itself in terms of who it caters to and how it caters to them. How big could the whole e-commerce really get?
So first of all, thank you for having me. I would say we're barely starting. When you think about e-commerce, it's all about working backwards from our customers, which we've been doing for 6 decades. Now, as we started ramping marketplace up, that's just been the past 3 years, when we open to more sellers from more markets to be able to bring the additional assortment for our customers. What we see is customers want options and choices, they want convenience, and they want low price. So when you think about expanding more categories, you think about expanding more services to sellers. For example, last week we just announced premium beauty to marketplaces. That's a new addition, and premium beauty is one of the top performing categories in beauty. We announced collectibles last week. We announced expansion of pre-owned. So if you have kids like me, you would want to have an option of a high-quality, lower-cost iPad that they can break, which they did for my kids, so I can save money to spend somewhere else. So what we do is help people save money and live better, and the more choices we bring to the platform, the more we see our customer cohorts increasing, buying more often, buying more items.
Well, I have to say, when I think of Walmart, I don't think of Kendrick Lamar or like Jordans, and I don't think of some of the StockX offerings that are coming out there. And we often talk about how the consumer is trading down when it comes to Walmart, and they actually are looking for deals. That's not really accurate. It's much more that Walmart is catering to different customers, correct?
Yeah, I think you put it aptly. It's about us serving a wider customer base. When you think about, again, marketplace, right, the broad assortment that we bring, we see that our customers are looking for a variety of items. It could be a rare collectible item they're searching for. It could be pre-owned example I talked about. It could be premium beauty. It could be a refurbished Dyson, for example, right? So we all sell all of those different items. And to give an example, the Kendrick Lamar shoes, right? So we see a lot of people going after coveted current culture items. StockX, if you know about them, they sell sneakers, they sell collectibles. And we, Walmart Marketplace, is the first destination they've come to list their assortment. So we're starting them next week with hundreds of SKUs, and we plan to expand that to tens of thousands. So now, as a customer of Walmart, and guess what? You can buy a grocery, you can buy a fresh food, you can buy any assortment you want. You want to buy luxury fashion items from us and trust, the same trust and convenience that we bring to the table.
There's this sense that you get a sort of a lower cost fulfillment, a lower cost distribution for participating with Walmart. What's sort of the vision for that distribution? Is it mostly just going to a store and picking it up? Is it that there will be a Walmart fleet similar to what we see with Amazon and FedEx?
Just much more than that. So I've been a seller as well on the platforms, and I've worked in different marketplaces. Fulfillment is one of the most challenging aspects for any business, be it a small business or be it a large brand. So whether you're an entrepreneur or large company CEO, fulfillment is complex. We have become incredibly good at it. We've been doing this for the past 60 years with an incredible supply chain operations team. So Walmart Fulfillment Services, or WFS, is our low-cost end-to-end network that powers our sellers with the same world-class supply chain that we built. It offers prices that are typically 15% lower than market. It basically is end-to-end, so we have our sellers back. Our sellers have actually asked us to extend that service to their own business. So think about them serving non-Walmart sites and customers. We announced last week that this month they can actually do that. Another aspect of it is our sellers have asked us, can you help us pick up the items from end to end? Pick it up from Asia, put it in the right fulfillment centers, fulfill it. We announced that as well. So we are doing an end-to-end one-stop shop for our sellers to be able to use.
One thing that Amazon's been accused of is prioritizing their own brands and sort of downplaying some of their customers. It's one sort of reason why you've heard a lot of pushback, and Lena Khan sort of pushing back on that. How does Walmart...
A category of its own. We are more than a marketplace. That's what we're building. So building all the connectors of a marketplace, fulfillment, ads, omni-channel. There's no other retailer with the broad reach that we have to our customers, with the digital and physical integration that we have. And when you think about it, 90% of America is within 10 miles of a Walmart store, right? Omni-channel is a really strong advantage that nobody else offers. So when you think about omni-channel, let me bring it to life. On our marketplace, sellers can sell tires that they can ship to more than 2,300 of our super centers that have auto care centers. So you can ship the tire, we'll install it for you. Like that basically erodes the boundary between 1P and 3P for a customer and just has the excellent experience you can deliver. Second, you can walk into more than 4,000 Walmart stores and just return your item. That's again a very key advantage. Third, what we see is we had Seller Summit last week, and we had merchants who were talking to our sellers, and the line was out the door. We've seen really strong brands come in through Marketplace, list their entire assortment, and then if they're performing really well, we put them in stores. Arctic Cooler is a pretty good example of that. And last but not the least is we really believe in working together. So we are building the platform for sellers to serve our customers with sellers.
How big do you see the marketplace getting? How big do you see, just in general, e-commerce as a proportion of the overall business?
I think Walmart e-commerce and marketplace is the biggest opportunity in retail. And the reason is we're just starting, right? We're a few years old. We only opened to new sellers a few years ago. And think about, again, large premium assortment categories and experiences. we're getting more and more brands on board. So it's all from customer demand, right? Every morning when we wake up, we think about what a customer's looking for. We want to make sure those items with the right price, with the right quality, with the right speed is on the platform. Premium beauty is attracting more brands. Collectibles, I mean, this is going to keep on going. We're just starting.
There's a sense also going forward about how you plan to arrange with certain geopolitical concerns with respect to regions. Are there certain regions that you see this expanding in more than others?
So we are in about 19 countries, but think about marketplace, right? So we are US, Canada, Mexico, and Chile. And last summit we announced was sellers wanted to be made easy for them to reach our customer base. So as we expand these marketplaces, these sellers are not able to sell into all those countries with a single click. What we educate our sellers on is this is the in-demand assortment, or this is what customers want. How to get them is what they work on business, and we expose their assortment search. So search, for example, we're talking about this, right? It works on behalf of the customer. When you walk into a Walmart store, there's a store associate or a manager who would help you find the item that you need. They'll guide you to the TV, they'll guide you to the Samsung TV that you want. Think about search as an online store manager. So it's irrelevant to us whether we own the inventory or a seller does, and we work on their behalf to give you those items.
How are you deploying AI in this? Because that's sort of the hot topic, and you've got a lot of data that you've accumulated through the website.
Yeah. So AI is spread across our ecosystem. And think about, again, from a seller-based standpoint, what we do is, if you're listing an item, we make it easy for you. We'll help you figure out the right images, the right content, the right category structure that you can list on. We'll help you with intel on what the price could be in the market. Same thing that's implemented across the supply chain as well. So it's across. There's no one vertical. It's embedded in the DNA of the company as we expand.
In 10 years, do you think Walmart is going to be a platform? Do you think it's going to be an advertising and media company? Do you think it's going to be a big box store? Or do you think it's going to be all of the above?
I think it's going to be, and it is, the first place to shop for our customers, and it'll be the first place for our sellers to stop. Because if we have those right items, our customers come more frequently, they buy those items more frequently, and they can find different ways of delivering it. So it's the first place to shop.
Manish Juneja, please don't be a stranger. Thank you so much for being with us. I look forward to talking with you more as this does evolve. It is 3 years old. John, this to me is fascinating. We've talked about this extensively, just how Walmart and other companies, but Walmart in particular, has really been expanding into a very new market. And this really gives you a sense for my sneakerhead son, just how much
of course
they are.
We knew this was personal. Lisa, thank you. Brilliant coverage this morning, and looking forward to having you back in the hot seat a little bit later tomorrow morning. Lisa at the Goldman Sachs Global Retailing Conference. Look out for more conversations from that throughout the day on Bloomberg TV and on Bloomberg Radio. Coming up tomorrow, looking forward to having Lisa back because we've got quite a 24 hours coming up. Your trading diary, the calendar, looks like this. JOLTS data coming at 10 a.m. Eastern time, along with durable goods, plus the Fed's beige book coming at 2 p.m. Eastern. Tomorrow, we'll get the ADP employment report, plus another round of jobless claims and ISM services. And on Friday, it's the main event. It's Payrolls Friday. It's a pretty soft start to the month of September. The losses continue. We're down 0.25% on the S&P 500, pulling back just a touch. Going into tomorrow to respond to all of this, John Stolfus of Oppenheimer, former HUD Secretary, Sean Donovan, Ed Al-Husseini of Columbia Threadneedle, and Kathy Jones of Charles Schwab. From New York, this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator. Invest in that. Think about it. We have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
All right, we're down again after the biggest drop in live trading since August 5th. Yesterday, 30 minutes until the start of trading. Today, I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, chips are down. A global fight from risk assets continues as NVIDIA suffers a record rout.
Meanwhile, Intel's money troubles may soon be a political liability. Details ahead on what this means for America's so-called chip-making renaissance.
And going private, the Nordstrom family offers to buy its namesake department store chain for nearly $4 billion. All that and more coming up, but let's take a look at where markets are trading after a brutal start to September yesterday. No relief bounce right now. The S&P 500 down about 0.3% pre-market. Once again, it is big tech that is the biggest loser here. The NASDAQ 100 down 0.5% pre-market. The bond market pretty quiet. We did see a big haven bid bring yields lower yesterday, but right now the 10-year yield, I would go ahead and call that unchanged, Matt.
All right, we're waiting for the JOLTS job openings number. Last month, they were more than 8 million, more than 1.2 jobs for every job seeker out there. But we've seen a divergence. Here in the blue line, you see U.S. job openings. The white line is the S&P, and you can see that even though job openings have come down, the S&P, the stock market, continues to rally.
Let's look at some stocks under the hood before the market opens as well. We mentioned NVIDIA. As sources tell Bloomberg, there are concerns that the company is making it harder to switch to other suppliers and penalizes buyers that don't exclusively use its artificial intelligence chips. And on the heels of that report, after a record rout, you have NVIDIA down another 1.1%. And the Nordstrom founding family has offered to buy the retailer for $23 per share in a cash deal, implying an equity value of $3.8 billion. But Nordstrom is down about less than 1/10% here, roughly flat on the day. Remember, the offer, Matt, is just about the average of the 5-year of trading averages here, Matt. We'll see how the market reacts once the market opens.
Yeah, 7 cents or a third of 1%. Really, though, it's NVIDIA that has to be the focus of the market. Yesterday, down 10%. Even before we got news that the antitrust probe, Bloomberg Intelligence antitrust litigation and policy analyst Justin Teresi joins us now. So I guess there's a couple of issues here, Justin. First of all, the huge drop. They were literally decimated in yesterday's trade. And then after that, we got this antitrust probe. Did people know? Was there a leak before the announcement?
So a busy day for sure, I'd say, for NVIDIA. But what's really important to remember here is that news broke a couple months ago that DOJ was already starting a probe into NVIDIA on a series of antitrust concerns. So it's this next step here, the issuance of a subpoena. In many ways, that was really expected. All that had happened before is that informal inquiries were issued that didn't really have the force of law behind them. So what this does is guarantees now that NVIDIA, in complying with the subpoena, which will take quite some time, I should add, what that's going to do is NVIDIA is going to have to certify, basically, that what they're producing and handing over to DOJ is the kit and caboodle of what they're asking about.
And so I'm curious about how this wraps into sort of the U.S.'s geopolitical ambitions when it comes to the chip industry, because NVIDIA is the global leader in chip making, and you have to think that the United States wants it to keep that position.
Well, that is certainly the argument you're hearing from some folks on Capitol Hill right now with regard to the antitrust concerns that we're looking at.
Well, we should also point out, NVIDIA doesn't make chips, right? NVIDIA gives their designs to TSMC to make chips.
Well,
in Taiwan.
Be that as it may, we're seeing acquisitions by NVIDIA now, right? Where this issue of consolidation in that space is raising some red flags. But to your point, too, about global dominance, we're seeing investigations of NVIDIA by several authorities around the world. The most stark maybe being the French raid of a NVIDIA office last fall, which was followed up with news last month that charges are likely to happen there in France. So it's not isolated to America. We're seeing this around the world. And really, this issue of dominance is one that some folks are actually saying is a fallacy in the AI space.
But NVIDIA is so far ahead of the pack at this point. How much are these allegations, or even the probe itself, really something that would lead to more of a slap on the wrist rather than a dire outcome?
Right. So it's impossible just yet to know exactly where DOJ is going. We're getting these mini leaks, if you will, the last few months, right? So what we know so far is that consolidation in the industry might be one issue they're curious about, but another might be things like tying products together, forcing customers perhaps to buy two products instead of one. In order to get the services of one product, you have to buy both of them. Those are things that can raise an anti-competitive flag when somebody has an extreme market domination position. So that's something we think authorities are looking into. But we're years away, I think, from any structural behavioral changes that we're likely to see at the hands of this investigation. It's going to take a long time for DOJ to get through these documents that they're going to get from the subpoena.
Justin, we thank you so much for your time. Bloomberg Intelligence, antitrust litigation, and policy analyst Justin Teresi. We're going to check here on futures because, of course, we had a brutal day in markets yesterday, resuming those declines today, with S&P futures down about 0.3%, and NASDAQ 100 futures down another 0.6%. The VIX remains elevated at a 22 handle. And it's interesting, Katie, if we talk about that daisy chain of events, as you like to talk about, you started the week, really, the trading week here in the U.S., with hawkish comments over in Japan by the Bank of Japan governor, really setting off a risk-off attitude in assets, maybe an extension of that carry trade unwind. And then really that ISM data coming in softer than expected, setting off the markets even more yesterday downward. Right. A record rout in NVIDIA, only to lead to the end of the day that DOJ news that came after the market closed.
I heard a quote on radio this morning that I think really nicely synthesizes the mood music right now. Quincy Crosby saying that this is the kind of market where everyone turns into a technician. I mean, we're all searching for answers here. Now we're talking about RSIs, we're talking about support levels. We were talking about death crosses and golden crosses in our morning meeting. I mean, at the end of the day, who really knows? There are so many different cross currents in this market right now.
Yeah, and it does seem like a lot of noise to me. Let's bring in someone who strategizes about equities for a living. Stuart Kaiser joins us. He is Citi's head of U.S. equity trading strategy. I want to start with the yen carry trade. I mean, how much of this is really noise? Because it gets put on and then it's unwound, we're told, but you can't really gauge how big it is. Now, I guess it's been put on again. Can you use it to your advantage?
I mean, our view in yen carry trade is it may be disruptive a bit. We don't think there's a whole lot of direct equity ownership, coming through the yen carry trade. So this is much more of a spillover issue. Other assets start to move, you get volatility in the markets, and equities kind of pick up on that. It's funny, a couple weeks ago, everybody was saying, oh, the yen carry trade's totally unwound, and we don't need to worry about it anymore. Our view is that's not the case. This is a trade that's accumulated over multiple years. You don't rebalance that in 2 weeks. So it is something that's going to be in the background, and people are very attentive to it at the moment.
So is it not really a tempest in the teapot? Is it more so kind of this slow bleed that's under the market?
I guess that depends how quick people decide to get out of it. Look, I think it's when the yen carry trade is something most equity investors would not have even discussed 6 months ago. So to your point, people are looking for signals, looking for where true north is when you have kind of volatile markets, and that's one thing to kind of focus on. I think the area I'd be more concerned about, frankly, is what's going on with the Nikkei. The Nikkei has been a very, very popular long trade for a lot of investors for a period of time. The BOJ seems to have disrupted that. That's not directly the yen carry trade, but it is sort of a global equity market that's under a lot of pressure. And when you get volatility shocks in one region, those things impact global portfolios and tend to impact other markets as well.
So respect, of course, the unwind of that yen carry trade. To your point, this is something that accumulated over years. It's probably going to take more than a couple weeks for it to be unwound. Let's talk about sort of the spillover into U.S. equity markets, though, because there was some really fascinating trading going on with the VIX. Right now, you take a look at the VIX, trading with a 22 handle on its way to 23. We're not exactly in the 60s like we were a month ago, but how are you reading that real jump in volatility that we've seen?
Yeah, look, I think it came into September with basically all-time high U.S. equity markets, immensely important catalyst at the end of the week, really bad September seasonals, and then you got some kind of weaker growth data, and I think the combination of that has gotten people to kind of de-risk portfolios. The VIX moving to 22, not that surprising given the type move you had in the S&P. The VVIX, which is the implied volatility on those VIX options, has moved significantly higher, and I think for trading desks, that's got a lot of people's attention because that's kind of what was a symptom of the sell-off in early August. It's clearly not completely resolved itself as much as people would like it to have done. So look, you have a combination of some growth impact, which impact the cyclical sectors, and then you have a positioning impact, which is affecting the VIX and the tech sector in particular. And we're just going to have to deal with it because there's not really a compelling reason to add risk right now ahead of that payrolls print.
But what's the compelling reason to sell off stocks at the pace that we saw yesterday? I mean, heard someone say it was growth concerns, but didn't we just get a GDP print at 3%? I mean, as inflation is down at 2.5%, unemployment is still at 4.3%. I mean, these are all great compared to historic averages. So, is there a real growth concern?
Yeah, there is. Look, I think
with earnings up 11%, with sales up 5 and change. I mean,
he's the bull on the desk.
Look, those are all positive things, and I don't argue with it. But I would say you've transitioned the macro trading environment over the last month or two. You were in a higher for longer environment where U.S. economic data was surprising to the upside, rate cuts were being priced out, and equity markets were being pushed higher. That changed at the end of June and into early July, where economic data is now surprising to the downside. So the market isn't trading higher for longer right now. They're trading a slowing growth environment. And when you're trading a slowing growth environment, the risk reward is very poor because you get near these borderlines where it could be hard landing, it could be soft landing. And I think what that means is growth data like the ISM becomes more impactful than it has been. We used to trade the ISM, and then for 2 years we stopped trading it because we were so worried about inflation. I think what the market's telling you is in this slowing growth environment, every growth data point just carries more importance, particularly with equities at all-time highs, valuation stretched, and payrolls on Friday. So I think it's the compelling reason to sell was risk reward isn't great. We were at an all-time high, and people felt the need to de-risk ahead of what could be kind of a market-changing catalyst on Friday.
What's more is to use an analogy here. If you're cooking and you hold on to a cast iron pan with empty hands, with no really pot holders, you can't pick up the pan again. And is that what we saw in August, where the way people were positioned they got burned. They got burned. They can't really participate in this market as it draws down.
Look, people definitely got hurt in early August when you have that kind of VAR shock go through the system. I think also kind of what happened is you had some risk put back on at the end of August. That's why you got back to all-time highs, right? But people were being very selective and cautious with that risk because they knew what was to come in September, which is payrolls, which is FOMC, which is a very important debate, and another CPI print. So I think as much as people might have wanted to put some more risk on, to your point, A, they had a VAR shock, which hurt their portfolios, and B, people looked a month ahead and said, what's the point?
So if you're going to make a bullish bet on the market, say you look a month or two out, if you want to play it through the options market, how far do you have to look out before you really materialize those returns?
Look, I think if you're buying options now for a bullish view, you're probably looking at a 3-month sort of 25 delta call type situation. It's very hard to trade anything sub a month if you actually have a structural bullish view here because there's just way too much kind of event risk, layered into the system right now. Will people be willing to do that? It remains to be seen. There is a bull case there. To Matt's point, there is a lot of strong economic data. Earnings were pretty positive. If, let's say we print on the consensus on Friday, which is 165K, if you print 165 and the Fed still does a 25 basis point insurance cut, there is a good case there that you should be long equities and long small cap in that environment. The problem is if you print 125K, it's the exact opposite trade. And it's that sort of dichotomy in the markets right now, which I think is keeping risk takers very cautious.
Well, looking at the here and now, I mean, to follow up on Shanali's burning metaphor, I'm trying to one-up that, and I can't, but you saw a lot of people get flushed out, I assume, in August. What does the state of positioning look like right now? If you take a peek into the options market, into the derivative space, what does sentiment actually look like right now as we skate into some of those risk events?
Yeah, look, a lot of it changed yesterday. You know, if you were coming into September, you would have said, you know, vol looks pretty low, skew isn't too elevated. It's a modestly bullish kind of setup in equities. You know, when you move the VIX 6-8 points higher in a day, and you put the VIX back to 130, and you kind of, you know, jam skew a little bit higher as well, right now it's going to look tactically conservative, right? And that's appropriate, I think. I think the market is right now trading event to event over the course of every week, the next 3 weeks, you have what you would consider a really important macro event. I think the market's going to have to trade that. So where is sentiment? I think a lot of risk got taken off in early August. As I mentioned, some got built back, but it got built back in a very conservative way. So I think right now it's you know, trust but verify. You know, you have some risk on, but you're being super, super careful about it, and you have to be really, really aware of where the landmines are.
All right, Stuart, so great to have you on a week like this one. The VIX right now camped out at 22.5. That, of course, is Citi head of U.S. equity trading strategy, Stuart Kaiser. Now, coming up, Intel's financial struggles could be a major setback for the U.S. chip-making renaissance. We'll discuss that and, of course, how it fits into the U.S. policy scene with Libby Cantrell. She is PIMCO head of public policy, joining us next to discuss. This is Bloomberg.
Principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Blackstone has agreed to buy AirTrunk, an Australian data center operator, at a valuation of just over $16 billion. The deal would be Blackstone's biggest ever investment in the Asia-Pacific region, and it includes debt and capital expenditures for committed products. The transaction is pending regulatory approval. U.S. Steel's CEO, David Burritt, said the company would close steel mills and move its headquarters out of Pittsburgh if its planned sale to Nippon Steel collapses. That's according to the Wall Street Journal. Burritt said that the Japan-based company's nearly $3 billion and investment in U.S. Steel's older mills is critical to keeping them competitive. Those comments come after Vice President Kamala Harris earlier this week joined President Biden in declaring that the United States, the U.S. Steel, should remain domestically owned and operated, and obviously Trump thinks the same thing. Now, the government's bet that Intel will lead a U.S. chip-making renaissance, as in actually making those chips, is in grave trouble thanks to Intel's mounting financial struggles. 5 months after the president traveled to Arizona to unveil a potential $20 billion package of incentives, there are growing questions around when or even if Intel will get its hands on that money. Katie?
Let's keep the conversation going now with Libby Cantrill. She is PIMCO's head of U.S. public policy, joining us now on set. Great to see you in person.
Nice to see you.
So building off that Intel conversation, I mean, it just feels like the U.S. government was taking victory laps on this. This was supposed to be a big lifeline for Intel. Now there's questions as to whether they're even going to build that factory. So when you think about the good that this legislation was supposed to do, revitalize U.S. chip manufacturing, I feel like in some ways it reveals how difficult it is to actually do this.
Absolutely. And this comes at a really inconvenient time for both President Biden and for Vice President Kamala Harris. Of course, Arizona is a critical swing state, as is Pennsylvania, in terms of your comments about U.S. Steel. So this is certainly not convenient. I mean, just in terms of the fate, though, of chips, I mean, this is going regardless of who wins. The CHIPS Act is now, it is codified into law. I think that just in general, there is a sense in Washington, D.C., that from a national security perspective, being not only the sort of the innovator of advanced chips, but also being the manufacturer of advanced chips is just critical to national security. So almost regardless of what happens with Intel, this will be on the books, and I would not be surprised if we don't see kind of more policy making in the semis space, going forward,
right.
regardless of what happens.
First of all, they also want to build a factory in the great state of Ohio, which I feel compelled to do. Obviously, it's become a Republican state, but could still swing a bit. And the problem is the U.S. government wants to make chips in the U.S. Obviously, we design them with a number of companies, NVIDIA being the biggest in the world, as Katie pointed out earlier, but we need to make, according to our goals, a fifth of the most advanced microprocessors in the world by 2030. We need to make them for the Pentagon, and it doesn't seem like we're going to be able to do that if Intel doesn't have enough money to complete these factories.
Yeah, I mean, and again, this is coming at an inconvenient time going into the election cycle, because to your point, this is something that I think, both sides of the aisle, but particularly President Biden and Vice President Kamala Harris sort of were, relishing in, that this was, a bipartisan legislation that, again, speaks sort of to our national security goals. So I think that there is sort of the politics here, and then there's the actual kind of business sort of implications. But from the sort of the political realm, there's just a lot of support for semiconductors, and regardless if it makes actually sort of rational sense, whether we are actually manufacturing this here in the United States, there's a lot of bipartisan support for this.
I want to switch gears a little bit and talk about another hot button issue. Of course, chips is one, taxes are another. And we have reported also that Kamala Harris is looking to increase the deduction for small business taxes by tenfold. How much does that move the needle in her bid to win more votes?
Yeah, look, I think that this is something we're really underscoring with our clients, that tax is going to be really sort of the singular focus in Washington, D.C. next year. And I cannot underscore this, that basically there's going to be a lot of headline risk here as the individual tax cuts as part of the Trump tax cuts in 2017 all expire at the end of 2025. And practically that means that not only is the small business deduction going to be on the table, the corporate rate's going to be on the table, that obviously the individual rates will be on the table. Carried interest is also going to be in the mix. And so this is going to be, there's going to be a lot of headline risk. I think that the importance for investors here is really separating the rhetoric from the reality. And the reality is really going to be predicated on the composition of Congress. So it's not only who's in the White House, but it's who controls the Senate and who controls the House. Our view is that likely a very narrowly divided Congress is the base case. That certainly can change though over the next 2 months. But regardless if it's a Republican sweep or a Democratic sweep, the margins are going to be very narrow, and that is going to necessarily sort of dictate what's in the tax bill. So a long way of saying, I would just take all of these sort of headlines around Vice President Kamala Harris is sort of suggesting, what former President Trump is suggesting on the tax front, with a big grain of salt, because this will all be in the mix next year. But again, we'll be beholden to the composition of Congress.
Let's talk about the debate. I believe your note said something to the tune of it's hard to overstate how important that debate is. Let's try to do that right here, because we're finally going to see Harris and Trump face off against each other next week. You think about the polling up to this point, Harris has a lot of momentum, but it's still a dead heat, and a dead heat is not a runaway win. When you think about how the debate could actually play into the polls, how high are these stakes?
Yeah, I would say that this debate is going to be very important. And again, I think the June 27th debate with President Biden sort of answered the question that debates actually do matter. In fact, they completely can change the face of a race. And this one is particularly important. I think Kamala Harris in many ways is still reintroducing herself, or introducing herself to a lot of the electorate. I mean, a lot of folks think there's about 5 to 10% of the electorate is still persuadable, and so this debate will matter. Now, I think that the big question is whether former President Trump really prosecute the case against Kamala Harris? Can he bring this idea of gas and groceries back to the sort of the front burner? This is an issue that obviously plagued President Biden. Vice President Harris has been able to distance herself from that. So can he kind of prosecute the case? And then similarly, can she distance herself from the Biden record enough? While still, obviously, the reality is that she is the vice president for President Biden. So can she sort of, distance herself enough from Biden while still kind of landing some punches on Trump? So I do think it's going to be very important. Again, the polling is very close. Our view is this is a complete jump ball.
Libby, unfortunately, up against the clock. Really great to see you. Of course, that is Libby Cantrell. She is PIMCO's head of U.S. public policy. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
All right, 4 minutes ago until markets open. It's not too pretty out there. The S&P 500 building on yesterday's sell-off, currently down about 0.4% pre-market. The NASDAQ 100 even more so, off by 0.7%. And it's your small caps that are the relative outperformer today, Matt, currently off by about 0.2%.
All right, coming up, Bernstein's Alex Chaloff joins the show as traders prepare for a down day again. Less than 4 minutes to go until the opening bell.
what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
We are moments away from the start of trading, looking at another down day. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at futures right now off on the S&P about 1/3%. The NASDAQ futures down about 0.7%. And this after the worst day for stocks since August 5th. NVIDIA alone fell 10% yesterday, and that is obviously a huge drag on the market. Here, you hear the opening bells, Eastman ringing it down at the New York Stock Exchange, BioMarin ringing at the NASDAQ, and not a pretty day, really, to ring these bells, unless maybe we get a great JOLTS number. On the other hand, a good jobs number could mean that the Fed cuts less than maybe market participants want. Let's get over to Katie Greifeld right now for a look at how the indexes are trading in the initial seconds.
Well, it feels like there is a long way between now and Friday, and you take a look at what the majors are doing right now, seconds into the trading day, and that is continued selling pressure. The S&P 500 off by about 0.4%. We were looking at a 2% decline yesterday. Clearly, there's still sellers in this market. You take a look at the NASDAQ 100, leading losses once again. The NASDAQ 100, your big tech names down 0.7%, and small caps, they also had a 3% decline yesterday on the Russell 2000. That index currently off by about 0.4%. And part of the reason things were so ugly was because of NVIDIA. We're taking a look at shares this morning after yesterday's 9.5% decline, currently down about 2% right now on a deepening antitrust probe into the chip makers' practices, with sources telling Bloomberg that the DOJ is looking into whether the company may be penalizing buyers that don't exclusively use its AI products. Shanali, another down day for NVIDIA at this moment.
Katie, I'm also looking at some movers, big movers, really, after a set of earnings last night, including security software firm Zscaler, which disappointed Wall Street. Its price target was lowered this morning by Wedbush, Piper Sandler, Jefferies, and Barclays. You now have Zscaler down more than 16% at the market open. Meanwhile, GitLab outperforming expectations as the software company deals with growing competition. You have GitHub really up more than 14% at the open. GitLab, sorry, Matt.
Thank you. Companies reporting this morning include Dick's Sporting Goods, which raised its forecast for sales and earnings, as well as Dollar Tree, which faces longer-term challenges as consumers pull back on spending and staying in retail. JW Nordstrom's, the founding family, has offered to buy its namesake department store chain for nearly $4 billion. But let's get back to the chip stocks leading the sell-off. For that, we turn to Bloomberg's Abigail Doolittle. Abby?
Yeah, phew. For a moment, I thought you were going to ask me to talk about these retailers, but we are talking about chips because yesterday was the worst day for the stocks, or that Philadelphia Semiconductor Index, down more than 7%. The worst day since March 18th of 2020. That was the degree of the selling power, that fearful selling that we saw in that pandemic bottom. That was yesterday. Today, NVIDIA down, once again, down 2%. Now over the last 5 days, down about 18%. The worst 5 days for NVIDIA going back to September of 2022. We'll be taking a look more at NVIDIA in a moment. But take a look at Broadcom, Supermicro Computer, and Intel. Those stocks that are more exposed to AI are down more. So the NVIDIA sell-off really bleeding into the rest of the sector. Let's put it into the perspective of what I was just talking about for that stock. So here was the drop, down nearly 8% yesterday, down 7.75%. Lots of green, lots of red over the last roughly more than 4 years. But again, this was the type of selling that we saw back in March of 2020. If you remember, where it felt like a video game, those types of declines, that was yesterday. And it seemed to come out of nowhere. But again, NVIDIA last week reported a quarter. Yes, it was good. Yes, they guided better than expected, but it wasn't the blowout. In addition, the sequential numbers are down about 50%. So for a stock that had gone so far so fast, at one point on the year, it had been up 180% prior to this congestion area, this massive range. So if we have this big drop here, it looks technically, you can draw a trend line here. It hasn't hit the trend line yet. Very likely to go sub 100. In fact, very likely to go back where it had been last year. Not entirely showing on this chart because it's not a log chart. But anyway you slice and dice this, Katie, it is painful for NVIDIA. It looks like more declines are ahead, and it's painful overall for the chip space.
And it's painful for the broader indices as well, of course. You think about the weight of NVIDIA and some of those chip names. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with Bernstein Private's Alex Chaloff. He is the Chief Investment Officer. He joins us now. And Alex, at this point, I mean, you could say that it's going to script September. We knew that this was going to be potentially an ugly month if you take a look at seasonal history here. But at this point, what is going to turn around sentiment? What do we need to see when we think about all of the economic data that we have coming up, when we think about corporate America right now?
Well, I think you hit it first. September is the new October. When I first got into the industry, people said, be careful of October. It's the worst month ever. The last 25 years has shown that it's actually September that has that seasonality and the pullback. No surprise, frankly, what's gone on the last couple of days. If you look at the selling that happened last week, it was really professional sellers talking to brokers, counterparties, the big desks. They were saying that the professional sellers had really been de-risking for much of August, post the Japan stress that happened now about a month ago. And so it didn't take much to have the pullback that we're seeing. This is natural. In some cases, it's needed. You're just showing a stock that's pulling back that's been up 120% over the last 12 months. So sometimes it's okay to have this kind of pullback. The data that we're looking at, frankly, you're going to get it on Friday. I mean, you're getting hopefully a jobs number that's really a needle threader that really pops, shows strength in the economy, but not too much strength. 165 is the consensus number. Hopefully a little bit higher than that, but not too much higher, and certainly nothing below. So I don't think you have to wait long. We've got, 47 hours until Friday jobs,
but
and I think you might get something
Alex?
there.
I think the reason it's important, as journalists here, we are shown to follow the money. And at the end of the day, I think it's important to think about who was really burned in August, how much money is going to be put to work when the opportunities really do arise, how much dry powder is sitting on the corner in order to drive this market meaningfully higher.
Well, there's $6 trillion odd in money markets. And I think that if you are in money markets today because you are spending on something in the near term, fine. If you're in money markets today because you're nervous, your return that you've been quoting the last 2 years that's been terrific, it's about to disappear. We get the Fed meeting in 2 weeks. It's highly likely that there's at least a 25 basis point cut, another in November, another in December. That's our view. Some in the market are even more optimistic about how much they slice that rate down. So if you're in money markets, enjoy it while it lasts, clip your last statement, frame it, because it's about to go away. And that's where the opportunity is, to come back into the market, to revisit risk assets of all types, from long duration intermediate bonds, all the way out to equities, all the way out to some private market investments.
What kind of equities do you want, Alex? Because it looks like the problem here is that these mega cap tech stocks have maybe run a little too far, too fast. At least in the case of NVIDIA, that looks like the issue. Earnings growth is slowing down for the Mag 7. Meanwhile, the S&P 493 is finally posting a profit compared to, 6 quarters in a row of an earnings recession. So do you rotate into those?
Well, Matt, if you're rotating now, you might be a little late. We've been talking about the forgotten 493 for a year now. And so thrilled to hear you mention 493. There is still an opportunity. There's an opportunity in healthcare. There's an opportunity in staples, some non-tech cyclicals. Credit cards are interesting. There's a lot of different areas that are showing profits and have a valuation that are nothing close to what you see in tech today.
But even still, Alex, I mean, it feels like you have to be so single stock specific in this market, because even with that broadening out that we've seen this past earnings season, you haven't necessarily seen those rewards, the fruits of that labor at the index level. I mean, even though maybe some of these small caps, some of these other sectors haven't gone down as much as tech over the past few months, they're still down. So when do you start seeing that sustainably rewarded, that broadening out in earnings power?
I think you're starting to see it. I'll push back a little bit. There are some names that have done really well outside of tech that have posted profits that are getting the love from the market. I agree with you. It's not everybody. It's not everybody, but that's okay. I like the days where there's some broadening out. I don't need the Mag 7 to be awesome 5 days a week for us to win. And I do think that placing, having an allocation outside of the Magnificent 7, or some names in there that you think are interesting, maybe not all of them are interesting, frankly. I think you're going to end up in a much better place a year, 2 years, 3 years from now. Some of those names, by the way, are tech and are AI related. A lot of the chip makers have run significantly, but what's an interesting opportunity for the next chapter could be those AI infrastructure players, the power generators, the cooling agents, a lot of the companies that really fuel the AI ecosystem that are the non-chip players. Those are still very interesting today.
Alex, what about energy? What about materials, consumer discretionary? If I look at, a breakdown of the industry groups over the last 6 months or year to date or 12 months, they're at the very bottom, and that's because of the concern about China and I guess the global economy slowing down. I don't see the slowdown here in the U.S., but they're still big losers. Are those bad bets because the economy is still weakening to come, you think?
I think some of them just have a different timeline, energy in particular, longer timeline. You've got to really, you're not going to get a short-term pop. It's unlikely that you'll get a short-term pop. But on a long-term basis, it's an interesting way to get some diversification. Banks are interesting on the other side of what we think the Fed does and the ramifications for commercial real estate and some of the pressures that have been overhanging banks. Man, I think there's a lot of ways to win outside of just the Mag 7.
Alex, we thank you so much for your time. That is Alex Cherloff of Bernstein Private Wealth Management. We will be on tenterhooks here as we wait over the next 48 hours, as he says, for the next set of economic data that will make an impact on stocks. And we are going to take a check on stocks right now as well, because we are looking at such a choppy trade this week. But the S&P 500 is trying to break into the green. We are looking at it roughly flat on the day, but the NASDAQ 100 still holding on to its losses for the day, down about 0.4% after a drawdown just a day ago that was its worst since August 5th, in almost a month here. You also have the Russell 2000 still down about 0.2%. Interesting to see the small caps faring worse. Now, coming up, there are growing questions around when or if Intel will get its hands on $20 billion in incentives from the White House. We're going to bring you details on that story next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Evercore ISI defending Amphenol. It's a maker of electrical components after it saw a sell-off yesterday in the wake of that semiconductor rout. Evercore says that the AI-linked weakness is overdone and that this stock remains a top pick with sizable upside to Wall Street earnings expectations. Next up, Morgan Stanley upgrading Astera Labs to a buy. The firm sees an attractive entry point and expects multiple tailwinds for the chip infrastructure company, including AI demands. And finally, TD Cowen says that Sweetgreen is a buy and raises its price target to $43. The firm says the company can achieve 5% same-store sales growth next year, thanks to a relaunched loyalty service and benefits from the introduction of steak into its menu earlier this year, Matt.
Delicious. Delicious. All right, we've got breaking news on the Bank of Canada. One of the coolest things about the Bloomberg terminal is for most central banks, you can just type in Fed Go or BOE Go or BOC Go and get the latest on that central bank's decision. So the Bank of Canada is cutting its policy rate now to 4.25%. Take a look at the loonie here and you can see, well, not much movement at all. All right, let's move on from Canada. The Biden-Harris administration's big bet on Intel to lead a U.S. chip-making revolution is in trouble as a result of the company's mounting financial struggles. We discuss with Bloomberg Technology co-host Ed Ludlow, also, I would say, an expert on Intel. You've interviewed Pat Gelsinger on a number of occasions, the CEO. Is he in trouble, Ed? I mean, are they going to be able to carry out Gelsinger's plans and get their hands on this money from the government?
Well, there's a line in the Bloomberg report from last week about Intel's direction to bankers looking at strategic options that Pat Gelsinger's running out of time. But there's frustrations on both sides, right? There's frustrations from Intel, according to our sources, that the CHIPS Act money they secured, $8.5 billion in grants and about $11 billion in loans, is not forthcoming. Intel wants it sooner, they want access to it, but it comes with strings attached, which basically is proof of work on their manufacturing footprint expansion and vetting. And that's the frustration on the administration or the Commerce Department's side. They made rules about that access to capital. Intel really needs it, but it's also, per our reporting, pulling back on its ambitions because financially it's under duress. And we seem to be at a pretty tricky spot right now.
And of course, Libby Cantrell from PIMCO was telling us earlier about how unfortunate this is for the Biden administration, just when it comes to timing here. But there's been a bevy of bad news when it comes to Intel. This is from Reuters reporting that Broadcom's tests involving sending silicon wafers through Intel's most advanced manufacturing processes failed, Ed. I mean, how big of a setback is that?
So what Intel would tell you is that they are actively engaged with, say, a dozen customers who would, on paper, take advantage of their manufacturing or foundry business. The cutting-edge process they have currently is called 18A. The Reuters report says that Broadcom ran a test. They ran silicon wafer through the 18A process, and it failed. And the conclusion, per the Reuters report that Broadcom reached, is that that Intel process is not viable for volume production. The response from an Intel spokesperson in that report was they're still on track for their original timeline. But to join all the stories together, Intel needs the CHIPS Act money to ramp up its foundry operations. It also needs third-party customers who are genuinely and tangibly revenue generating for them to use that to stem its financial losses. At the same time, they're having trouble proving that that process is going well, and per the reporting of Bloomberg last week, they're having to make tough decisions to scale back, be that strategic decisions like separating out the foundry business, or more likely, cutting back on existing projects. So how can you go in good faith to the US government and say, we want the CHIPS Act money sooner, but also be sort of looking at your own balance sheet and planning and saying, we're going to have to pull back on our manufacturing expansion because of the realities of our finances?
Ed, we thank you so much for your time and your reporting. That is Bloomberg Technology co-host Ed Ludlow. And coming up, the Nordstrom family makes its pitch to buy back the retailer. We're going to have details for you on that deal next. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
All right, this is Bloomberg Open Interest. Let's take a look at some specific stocks right now. Of course, we have some earnings reports there. We have Dick's Sporting Goods. We have Dollar Tree, both down mightily right now. We know it's been a really difficult time for some of those stores, of course, as consumers pull back here. But then, on the other hand, we have Nordstrom, of course, rising right now, up 1.6% right now. Shanali, of course, on some potential M&A news.
And Nordstrom is the focus today of our Wall Street beat. We're going to bring in Bloomberg's Crystal Say, who covers deals, joins us now. And she joins us actually from the Goldman Sachs Annual Retailing Conference in New York. I'm sure this is the talk of the town there. And Crystal, before we ask how you see this process going to spill out some of the facts of the deal, they've retained Moelis & Company. They've said in a statement, or a filing rather, that they are looking for financing, debt financing to complete this deal. And the offer of $23 in cash per share is contingent on that financing as well as a certain amount of shareholder approval here. Of course, this is the founding family of Nordstrom, but $23 is still really the average price of the stock over the last 5 years and well below the high. How do you think the story plays out, given what we know?
So first of all, it's really interesting to look at the department store space. It really has changed a lot in the past 5 years. They're quoting this, it's a 34% premium compared to their previous whatever period that they looked at. But if you look at department store, a lot of change in e-commerce, a lot of change in the way that people had shopped. So if you look at the 5-year horizon, it really wouldn't be too flattering for Nordstrom or for any department store. And like you said, there is a family component here. I think the most interesting thing about this Nordstrom situation is that the consortium, the Nordstrom family, and this Mexican department store actually own a combined 43% of the company already. So they're trying to buy whatever they don't own yet. And there will be a couple of hurdles, like you said, financing being one of them. But we will see how this plays out.
Well, and a poor outlook, as you point out. I mean, I get that the family wants to buy the asset because it's their namesake. They have a huge history here, but can they make money? What do they need to do to improve operations at Nordstrom? Do they need to invest a lot?
So there are different ways to run a department store, but a lot of people would say the real turn of the century really is that people shop online these days. And but then if you don't shop online, you're really valuing the experience. But whatever you're doing, being private, it's what they think it's a better option. If you look at Saks, which is a private company, they had actually explored things like spinning off their online business and doing, capturing the online valuation versus the offline brick and mortar store, and that allowed them to do that because you don't have to report quarterly. So this is probably what the Nordstrom family, as you pointed out, the family, the two members behind this deal is actually the great-grandson of the founding member of Nordstrom. So it has a family heritage there, but they're also looking at being away from the public eye and being able to transform Nordstrom as a company privately.
Johann Wilhelm Nordstrom, the founder, changed his name then to John W. Nordstrom. Crystal, thank you very much for joining us. Crystal C. there talking to us about this potential M&A action. Coming up in the next hour, Nancy Tangler talks chip stocks, Sharon Bell of Goldman Sachs on Euro versus U.S. stocks, and Raymond James CEO Paul Reilly is in the C-suite. This is Bloomberg.
we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, these new people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're inclusive with, right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Alex Steele, she's moving on to her TV duties. John Tucker sitting in for Alex for the next couple hours. We've got some economic data. The JOLTS data just came out weaker than expected, 7.67 million versus 8.1 million. We'll get to that in just moments. So we're also going to take a look at NVIDIA. It's a stock had a big move yesterday. Lots of issues there, including Department of Justice taking a look at that. So we're going to bring in the best of Bloomberg Intelligence. Mandeep Singh, he covers the industry, the stock, and we've also got Justin Teresi. He's a Bloomberg Intelligence antitrust litigation analyst. So we've got an expert on antitrust to kind of size up what this means for NVIDIA and for the tech industry. All that's coming up in the next hour. We're also going to check in with Michael McKee, get his thoughts on this JOLTS data as well. We got the jobs number coming up on Friday as well. September 18th is when your Federal Reserve meets next. We'll get all the latest from Michael McKee. But right now, let's go to Melissa Mateo. She is still here in studio. The Bloomberg Business Flash.
And going strong. Good morning. Market Drivers brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. All right, more economic data out. Where do we start? All right, let's start with, head over to JOLTS job openings. Experts expecting further decline, and we kind of see it here. So we have the survey was for 8.1 million, came in at 7.67 million. The prior was for 8.18. That was revised to 7.91 million. Then we want to head over to factory orders. The survey was for 4.9%, came in at 5%. The prior was a downfall of 3.3%. And we have durable goods orders. The forecast 9.9% came in at 9.8%. The prior was for 9.9%. Now on top of that, we also found out the U.S. trade deficit that widened to a 2-year high in July to 78.8 billion. That was thanks to a surge in import goods. A lot of American businesses stocking up on, as those dock workers consider a walkout. And then finally, the housing front. We had U.S. mortgage rates fell last week to their lowest level since April 2023 to 6.43%. That's a 30-year fixed mortgage. That's according to the MBA. And later this afternoon, yeah, we're not done yet. It's the September beige book. So the reaction, we have the NASDAQ down 0.4%, 83 points at 17,052. The Dow up 0.2%, 80 points at 41,017. The S&P 500, little change, down about a point at 5,527. Want to point out quickly, WTI crude, $69.91 a barrel. That is your Bloomberg Business Flash. Paul and John.
Ooh, that's a lot of stuff there, Lisa. Thanks so much for getting through all that. Lisa Mateo, thank you. John Tucker sitting in for Alex Steele for the next couple hours. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And we want to welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the FM dial, Bloomberg 92.9. John, what tons
it's
of
a big
data.
boy station with a real signal.
That's what I understand. Getting it all across New England.
50,000 flaming watts of business directed at you, Boston.
Exactly. Who doesn't need
I don't know
that?
how many watts it is, but
That's good news for them. All right, but the jolt's coming in a little bit weaker than expected. Kind of brings into focus, John, I guess, kind of what we're going to see Friday from the non-farm payroll.
And it raises the question for me, 25 or 50?
Yep,
So does that
absolutely.
reinforce the case for maybe 50 basis point cut from the Fed?
Yeah, that would be interesting to see. We're going to have Michael McKee in just a few moments. He'll break it down for us. You know, it's kind of got a mixed screen, as Lisa was just reporting, kind of some red, some green, something for everybody. After yesterday's sell-off, let's look under the hood and see where some stock action is occurring in the marketplace. We do that with Bailey Lipschultz. He covers all the equity markets for Bloomberg News. He joins us here in our Bloomberg studio. Bailey, what are you looking at?
I know you guys will spend some more time on the Department of Justice subpoenas for NVIDIA, but just want to call out the stock right now, down about 1%. Paul, when you take a step back from the last week high, August 27th, stock's down 17%, $543 billion in market cap.
Yeah.
So keeping an eye on NVIDIA. Again, modest decline today, down 1.3%, but still accounting for about 4 points in the red for the S&P 500. So the second biggest laggard when you look at it kind of under the surface, only behind Apple, which is down 2% this morning. Investors really going to keep an eye on that $100 level, which was the low back in last month, again, keeping an eye on that level from the last month's lowest close, but certainly a lot to digest, whether it's AI mania kind of running out of steam or those potential DOJ.
And I'm just looking at Rich Go, Jensen Huang, the founder of NVIDIA, yesterday. It's a bad day for him. Lost $10 billion.
Well, it's all paper losses.
Yeah,
but
still
I mean,
a
it raises
50
the question for
year.
you, what's the attractive entry point? What are you hearing?
People are looking at 100, and that's simply the fact that that is the closing low that we saw last month, or below that was last month's closing or intraday low. The big question is, when do you buy? And so many people are underperforming benchmarks this year. NVIDIA is still up more than 100% year to date. So we're seeing investors who had missed out on the rally putting money to work now, and investors who maybe had been long the stock for the last 6, 9, 12 months riding it on the way up are taking some of their profits and maybe rotating that into safer investments.
Has anything fundamentally changed at NVIDIA?
No, and that's the thing, is we're kind of at least what Evercore Wealth Management kind of put it, we're in a vacuum right now. There's now that earnings is in the rear view from last week, you're seeing the stock continue to drift lower, but the big question is, what happens with the Blackwell launch? What happens fundamentally going forward? And that's kind of the, I guess, uncertainty around the Justice Department investigation, is how could that impact the company, and as investors right-size their books, maybe that's why you're seeing a bit of selling pressure.
And we're going to have some more detail on that. John Mandeep Singh, Bloomberg Intelligence, he's the analyst that covers the stock. Plus, Justin Teresi, Bloomberg Intelligence antitrust litigation analyst, to give us the real feel for what the DOJ is thinking about as it relates to NVIDIA. How about Dollar Tree?
Bad day.
Yep.
Right now down 19%, your ticker DLTR, worst performer in the S&P 500. Second quarter earnings were a whiff. Full year guidance well below what analysts were looking for. Same store sales growth coming in below what analysts were expecting. You really are seeing this continue to play out. We saw Dollar General just a few weeks ago kind of sounding the alarm on lower end spending. Well, this is still playing out for Dollar Tree. The stock right now trading at a more than 4.5-year low, has done nothing really but move down and to the right. The company is basically saying that for the outlook for the rest of the year,
Dollar Tree, Family Dollar are going to be areas that they're keeping an eye on, but it does not seem good.
Do we use these stocks as bellwethers in any way?
For the lower end consumer, I think that's kind of what we saw a few weeks ago. Target beat expectations, Walmart beat expectations because your middle and higher class consumer is down spending and going for some of those private label goods. And this is a signal that at least your kind of least well off, poorest people are struggling.
But Paul, I go to Dollar Tree.
Yeah.
What is he saying?
I don't know. I mean, the stores, the quality of the stores, John. You have an opinion here.
I'm a fan of deals, but that's the other thing is that when they reported that the dollar spend per visitor is weaker than expected, that's another signal that people aren't buying additional goods maybe they don't need.
Again, just get a mop. Clean the stores.
Clean the stores. What is Zscaler?
Cybersecurity play.
How do you miss on cybersecurity?
They beat in the quarter, but the guidance is what was weak. And so there's a debate. Bloomberg Intelligence saying, billings growth expectations could prove conservative. A number of analysts on the street saying that the first half outlook actually is just going to be odd. This is a company right now, ticker ZS, down more than 16%. Biggest intraday drop since February. But again, billings seem weird. That's according to Barclays, very oddly shaped year. They kind of are coming out defending it. A number of analysts cutting expectations, but still remaining bullish. It's really, Paul, we're seeing it feels like still kind of shaking out winners and losers in what was such a hot space. And now you're seeing some of these companies trying to deliver on what seemed like overwhelmingly lofty goals. But again, adjusted EPS guidance for 1Q between 62 and 63 cents. Estimates were for 75 cents, so sharply
stock
lower.
down 17%. You know, like in the movie The Graduate, the future is plastics. I'm telling my kids, I was telling them, the future is cybersecurity. Yeah. I mean, that's never going away, I don't think, particularly with AI when all these machines are going to get even smarter and people are going to have different ways. So, all right, some good movement there in the marketplace, some ups, some downs. Bailey Lipschultz, thanks so much for joining us. Bailey Lipschultz, he covers the equity markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Eco Go, folks, it's been busy here this morning. That gives you all the economic data that's released by the government. A lot of stuff here, JOLTS, factory orders, durable goods. I mean, I heard about all this stuff in economics class. I didn't really know what it is, but I see the numbers here. Michael McKee, he knows what's going on. He does all the economic stuff for Bloomberg Television, radio, and everything else, actually. Michael, what of all the economic data here, what jumped out at you today? What do you think the Fed is going to focus on maybe today?
Well, the Fed's going to look at JOLTS because it does show the labor market is in a looser state. We're pretty much back to where we were pre-pandemic in terms of the number of job openings. It was a drop, a bigger drop than expected from last month, but the prior month, June, was revised lower as well. And when you look at what we've seen in the time series, we've seen job openings in the 7 million range for 3 of the last 4 months. So this is not a shock. It's not a major change in the overall outlook. These numbers are not necessarily super reliable. The quits rate, which people take as an evidence of how people feel about the labor market and whether they can continue to get jobs, still at 2.1%, where it's been for a long time. So it doesn't look like it's making major news today. Oddly enough, factory orders come in up 5%. Now, durable goods were up as part of that, a revised 9.8% from 9.9%. We knew that. So what that's telling you with a 5% gain after a negative 3.3% the month before is non-durable goods sales were pretty good. And that is good news for the idea that the Fed doesn't have to immediately cut rates or anything like that. Probably the most interesting number of the day, though, trade balance. The trade balance at $78.8 billion,
I wouldn't have guessed that.
The widest in 2 years, up from 73.0, and just a little bit lower than the forecast, but basically saying that we are importing a lot of stuff. Now, there could be 2 reasons for that. One, the economy is still in good shape and people want to buy, or 2, retailers are stocking up for the holiday season, which then becomes a question for your retail analysts of, are they making a bad bet or not? Is the economy going to slow? Are consumers going to stop spending and we're going to be stuck with a lot of inventory?
All right,
so
put that
that's
all
why
in
it's an interesting number.
Put that in your hat, shake it up. What's the trajectory for the U.S. economy based on what you've seen so far?
Well, it looks like the trajectory is pretty much the same as it was, that the economy has slowed. We're not seeing it fall off a cliff, and therefore the Fed is going to say, we can cut rates, but we don't have to do an emergency rate cut of 50 basis points or anything like that. We can do 25.
All right, Michael McKee, thank you so much for joining us. Really appreciate getting your expertise there on a bunch of economic data crossing the tape here this morning. Yesterday, NVIDIA suffered a record $279 billion rout as AI worries sink stocks. They also got a DOJ antitrust probe. A lot of headwinds for that stock, a lot of issues for investors to figure out for NVIDIA. Stock's still up over 100% year to date. Mandeep Singh, he's the guy we talked about NVIDIA all the time. He's Bloomberg Intelligence. He's pretty smart. But the guy we really want to talk to today is Justin Teresi, antitrust litigation and policy analyst for Bloomberg Intelligence. I've never met you before.
Likewise,
obviously.
obviously.
I didn't hire you, so I'm just going to go on Mandeep's recommendation. What's the DOJ saying here as it relates to NVIDIA, and how concerned should NVIDIA and its shareholders be?
Yeah, so I think the real takeaway here, the most important thing to keep in mind is the timing that's associated with this. So news broke a couple months ago that DOJ was looking into NVIDIA here, and what we think, there are a couple issues they might be interested in. One, market consolidation. Maybe NVIDIA is growing a little bit faster than the authorities would like to see. The other issue they might be interested in is one related to how they're selling their products. Are they tying things into anti-competitive manner? Are they bundling products in such a way that it's really impossible for other folks to compete? But really, this development yesterday, in terms of the subpoena, really is something we were expecting. And that's because it lays a formality upon this investigation that wasn't there before. Previously, it was an informal questionnaire. Now, NVIDIA is really going to have to certify that the information it's handing over to DOJ is what they're looking for and a true and accurate depiction of what they want to know about.
Is there a political element to this? I mean, everybody's got NVIDIA in their 401k. Does the Harris campaign pick up the phone and say, couldn't you have waited till after November?
I think that might be the question of the day with relation to this. So, look, if I'm NVIDIA's attorneys right now, what I'm trying to do is to delay responding to this as much as I possibly can, right? Because there is that element of an election coming up in November here. What does a new administration do with the investigation itself? How hard do they go? Are they more open to a settlement than the current regime might be? So that's really the name of the game here. I think you're spot on there, that really the tea leaves
And the
of
question
election.
for Vice President Harris, for me, is, are you going to continue this aggressive antitrust behavior in a new administration, potentially?
Right. So,
it becomes a real campaign issue, doesn't it?
It does, and I think it has, right? I think we've seen that already with a lot of rhetoric coming from both the Harris camp and, Trump camp, J.D. Vance on the issue too, right? So I think moving ahead, we think there could be some softening perhaps in some ways, or a more measured or deliberate approach to things if Harris were to win the White House. But what we see from the Trump camp is J.D. Vance does have that rather strong anti-big tech mentality whenever we talk about antitrust with him as a candidate. So really, we're not quite sure what to make of the situation there, but delay is the name of the game if I'm NVIDIA right now.
Mandeep, when you talk to investors or when you hear from the company, what do investors think about this risk? Is it just another big tech company facing some regulatory headwinds like we've seen for years?
Yeah, I think NVIDIA now is part of that club that Amazon, Google, and Meta, which have faced regulatory scrutiny over the years. And look, in the case of Google, it was fairly obvious that regulators doubled down on their distribution agreements that they had with Apple and Samsung to be the default search. So in this case, it would be interesting to see DOJ's approach. What is it that they really want to focus on in terms of how NVIDIA is distributing their chips to the hyperscalers and their largest customers? Because clearly, NVIDIA has a lot of interest from all types of customers. The market is undersupplied. So do they have an algorithm to say, okay, I'm going to distribute X number of chips to customer A and Y to customer B? And look, it comes down to NVIDIA's how they have their relationship with their customers, and they can distribute the chips they want.
I know. It seems like it's a market operating efficiently, but what do I know? But what I do know is the beauty of Bloomberg Intelligence is we bring together industry and company-specific research analysis, and Mandeep Singh, he's been doing it for years, and Justin Teresi, antitrust litigation policy analyst at Bloomberg Intelligence. We can bring these folks together. They can partner the research and integrate their research and give you a really good view of what it means for some of these companies as they face some of this risk from the regulators. And again, it's great to have that as part of Bloomberg Intelligence. BI Go on the terminal. Oh, and guess what?
NVIDIA shares seem to have bottomed out today.
Exactly. All right, Mandeep Singh, Senior Tech Analyst, Justin Tracy, Antitrust Analyst, Bloomberg Intelligence, in our studio, breaking it down for NVIDIA. It certainly cost the stock yesterday some serious corners loss. I think Justin Wang was $10 billion.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got red and green on the screen, and this is after U.S. job openings fell in July to the lowest since the start of 2021, and layoffs rose. So right now we have the NASDAQ down 0.4%, 73 points. The Dow up 0.2%, 99 points. The S&P 500, little change, down about 2 points. We have the two-year yield at 3.79%. That's down 7 basis points. A yield on the 10-year, 3.79%, and that's down 3 basis points. The sell-off in NVIDIA shares, it continues. The stock down about 1%, and this is after shares dropped 9.5% yesterday, wiping $279 billion off its value. Sources say the DOJ sent subpoenas to NVIDIA, other companies. It's looking for evidence that it violated antitrust laws. Mandeep Singh covers tech for Bloomberg Intelligence.
Right now, the question that they are looking at is how has NVIDIA allocated their chips in a market that everyone knows is undersupplied? There is more demand for NVIDIA chips than they can supply. So how have they allocated it?
So that trickle-down effect of the news being felt in the chip sector. We have Intel, who is also struggling in the growing financial issues. They're down about 1.5%. Chip equipment maker Applied Materials down nearly 1.5%. Even those big tech companies looking to reshape the economy with AI, they're being affected. You have Microsoft down about 0.5%, Apple down about 2%. Crypto-related stocks falling after Bitcoin touched a one-month low. Bitcoin now down about 3% at 56,000. You have Coinbase down about 2%, CleanSpark down nearly 1%, Marathon Digital down nearly 1%. That is your Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so head over there and search Bloomberg Podcast. And we want to welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the FM dial, Bloomberg 92.9. Speaking of Boston, let's go to our next guest, Paul Carter. He's co-founder and managing partner of Twin Focus, joining us from Boston, Massachusetts via Zoom. Paul, what are you telling your clients these days as to where the best opportunities are? We've got the S&P 500, up 18%. I mean, that's pretty darn solid, but yet I can still get a decent yield in a 2-year Treasury at 3.8%. What are you telling your clients these days?
Paul, John, thanks for having me. Here at Twin Focus, we've largely been invested according to our policy benchmarks all year. The expectation has really been for a soft landing, reasonable growth, low inflation, lower rates. Before today, before the JOLTS number that just came out, the Fed funds were pricing in a 100% probability of a 25 basis point rate cut in September, November, and December. With this most recent number, a bigger miss than expected, and it seems to be signaling, greater job availability out there and kind of a weaker job market. You've seen that Fed funds market respond with, perhaps a greater chance of perhaps 50 basis points cut at this next meeting. Given all of this, as mentioned, we've been focused on remaining fully invested, and we have been able to take advantage of the run in risk assets, but we're looking to diversify our risk more broadly and, away from this, purely the AI trade, if you will.
All right, Paul, I think this is one of those moments where I'm supposed to throw confetti in the air.
Sure.
The yield curve.
Yes.
Disinverted.
Oh, wow.
So 2s and 10s now, back to, I spoke too soon, but anyway. Do you attach, Paul, they used to tell me that inverted yield curve precedes recession. Well, didn't happen. Do you put, what's your significance of this, do you think? Do you pay attention to the yield curve?
We absolutely are focused on the yield curve. There's perhaps a number of reasons why we didn't see a recession. In part being this whole AI trade. The productivity that we've seen in the economy and the forecasted productivity that we will see from AI. That combined with a lot of the stimulus that was still waning and in effect after COVID. That said, recession, I think, at some point is not completely off the table. Hopefully we're able to escape with just a soft landing. But we're 18, 19 years into the business cycle here. So it wouldn't be surprising to see something at some point. There is this talk of rate cuts become obviously more prominent with some weakness in inflation. But I think that, it usually takes some time to see those rate cuts impact the economy. So we may not see that until Q1, Q2 next year. Until then, the market's going to try to decide on the overall direction. And I think we're just going to continue to see a lot of volatility between now and then.
Paul, in terms of maybe trying to temper some of that volatility, what do you guys, or how are you guys approaching the fixed income markets? Are you, I'm content to sitting in a 2-year Treasury at 3.8%, but some people might want to take some more credit risk. How do you think about fixed income opportunities today?
Sure. So let's talk about credit and kind of safe treasury allocations. You know, we've largely been barbelled with perhaps a bit of an overweight towards the shorter end of the curve. So when rates were up 4s and 5, we were taking advantage of locking in some 10-year money then. You know, while it's compelling to sit in a 3.5%, 4% short-term treasury, you do have some reinvestment risk if you see, you know, rates come down. So we have been starting to nibble at some duration. On the credit side, you know, we've been less enamored with this whole private credit trade that everybody seems to have fallen in love with. And so we've been focused on really more idiosyncratic return streams or areas of the market that seem to be more capacity constrained. And they're harder to find today, for sure, as there's a lot of money out there chasing various trades.
So you see a softening in private equity. I think in your investment note, you quote the great Roberto Duran. No mas.
No mas. Yeah, we've like many institutional family office investors over the past decade, 2 decades, we've allocated significantly to private equity, which has served us fine. But we think going forward, the market has completely changed, and there's just an enormous amount of market participants. There's just an enormous amount of capital chasing, and we found more compelling returns, frankly, in public markets, which, you know, I would have never thought I'd say that 5 years ago, but that's where we are today.
Hey, Paul, thanks so much for joining us. Really appreciate getting a few minutes of your time. Paul Carter, he's co-founder and managing partner at Twin Focus up there in Boston. If you're listening to us in Boston, our new home is now 92.9 FM in Boston. All right, one of the great stock symbols out there, one of my favorites, is just X, and that's for U.S. Steel. It's a great stock symbol. But U.S. Steel's in the news here. I mean, I thought Nippon was going to buy U.S. Steel, but apparently there's some risk there, and U.S. Steel comes out today and warns that thousands of jobs at risk without Nippon Steel deal. So I don't know what's going on. Richard Bork does. He covers all this stuff for Bloomberg Intelligence. Richard, give us the status or the update, the status of this potential deal with U.S. Steel and Nippon. Where are we today?
Okay, so we're waiting for regulatory approval from CFIUS, which is the Committee of Foreign Investment on the U.S. That's kind of hold it up. But there's been almost every politician in Pennsylvania, Ohio, the presidential election has come out against it because Pennsylvania, as many people know, is a huge swing state, was decided by 10,000 votes in the last presidential election. And they're courting their union approval. So there's been a lot of press against the deal, and I think today U.S. Steel just came out and said it's time to face reality and cold, hard economic facts that U.S. Steel doesn't have the dollars to invest in some facilities going forward where Nippon does. And if you kind of just look at credit rating, U.S. Steel's high yield, weak BB. Nippon Steel's investment grade, strong BBB. So they have more of the financial wherewithal to invest in these assets.
What's the fear? Nippon Steel's going to come in with giant helicopters and lift all these plants and take them to Japan? I mean, there's a jingoistic element that clouds some of the facts, one would think.
I think what it is there's a lot of its root into the problems between union and non-union facilities. And not only really at U.S. Steel, but they're afraid Nippon Steel would carry on the same tactics. For example, at Mon Valley, back in May 2019, U.S. Steel came out and said, we're going to invest $1.2 billion to upgrade Mon Valley.
Mon Valley is a steel manufacturing facility.
Mon Valley is a mill outside Pittsburgh.
Okay.
And union.
Yep.
And, old. And this was supposed to invest it. Later that year in October, U.S. Steel announced that they were going to buy Big River Steel in Arkansas, brand new mini mill, electric arc furnace mini mill, newer technology, cleaner, more sustainable, and but a non-union facility. Then they later that year, they announced they were idling Great Lakes, which was a former union mill in Michigan. And then December, they acquired the rest of Big River Steel. At first, they only bought the first 50%, then they bought the second 50%. Then April of 2021, they announced that they're no longer going to invest $1 billion in Valley. Right. So, it's kind of left bad blood between the union and U.S. Steel management, and U.S. Steel, our union is afraid that Nippon will carry on kind of the same tactics.
Do you think, how much does U.S. Steel need this Nippon deal to kind of keep going as a viable concern? Is there that kind of risk here? Does U.S. Steel really need to be acquired by Nippon?
I don't think it outlined a plan from how they were going to transfer. They call it bigger, better, best. That they were going to transform the company over there. And part of it is shuffling away from blast furnaces towards electric arc furnaces, which also is shuffling away from union facilities towards non-union facilities. Really, with U.S. Steel, this deal kind of took the execution risk off the table for shareholders. Like, okay, I don't have to wait to see if this plan will be successful, but they do need the times are changing. There's more premium for cleaner, sustainable steel, and they need to do this to compete going forward.
What's the market right now? Is there too much steel out there?
Well, the U.S. is kind of a funny market because U.S. has historically, we need 100 million tons of steel a year, but we only make 80 million of it, and we import 20. I mean, this has been probably for the last 20, 30 years. But the blast furnaces, which are predominant, make higher quality steel, but they're also bigger and more, it's a kind of a scale job, economy situation where you got to have scale. So in times of volatility, it's a lot harder on their results.
Right.
And that's kind of the where we're at.
All right, we'll see that U.S. Steel, they warned that thousands of jobs at risk without Nippon Steel. Another headline across the Bloomberg terminal, U.S. Steel employees to rally in support of Nippon Steel transaction. So we'll have to see how this plays out. Richard Bork, senior analyst who covers all the basic materials for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Brokers studio in New York City. Shares of U.S. Steel, $36.82. The stock is higher today on the news. Year to date, that stock is down 24% year to date. So we'll see how that plays out. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks rise, Treasury yields fall after data showing a further slowdown in the U.S. labor market. It lifted Wall Street's bets on Federal Reserve rate cuts. So now we have the NASDAQ up about 1/10%, 20 points. We have the Dow up 0.3%, 129 points. The S&P 500 up 0.2%, or 11 points. The two-year yield's 3.78%. That's down 7 basis points. The yield on the 10-year is 3.78%. That's down 4 basis points. To commodities, we have spot gold higher, $2,497 an ounce. We have Brent crude, $72.86, $72 a barrel. WTI crude, $69 a barrel. U.S. Steel CEO speaking out. He's saying the company would close steel mills, likely move its headquarters out of Pittsburgh if that planned sale to Nippon Steel collapses. Bloomberg's Kriti Gupta has reaction.
That's actually being well received by the market. It kind of looks like it's almost being interpreted as an efficiency story, that it may actually help the numbers there.
Yes, so now you see you have U.S. Steel shares up about 3%. To earnings we go. Dollar Tree shares, they fell the most in more than a decade. The chain lowered its full-year guidance as its higher-income customers pulled back on spending. Dollar Tree down 19%. And then Dick's Sporting Goods, well, it beat Wall Street's profit and revenue estimates, but said its full-year profit could miss expectations, and that has shares lower, down about 7%. And sticking with retail, the Nordstrom family, it offered to buy Nordstrom for $23 a share in cash, plans to take the retailer private for $3.8 billion. That's according to a filing. Nordstrom down about 0.3%. And finally, Uber kicked off its first bond sale as an investment-grade company. Sources say it's looking to sell bonds in as many as 3 parts. Uber up about 0.7%. That is your Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, and we're also in your dashboard, Apple CarPlay, Android Auto. You can get us anywhere you stream and do all that kind of good stuff here. Let's talk a little commodities here. I mean, John Tucker and I talk commodities. We talk the daily national average gasoline price, $3.31. I got a much better deal Jersey Shore on Sunday.
It's under $3 a gallon.
Is it?
Yeah.
All right, good stuff there. And I guess one of the drivers there is crude oil, WTI crude oil. We were under $70 a barrel a little bit earlier this morning. We're now at $70.45. Mike McGlone, he does all the commodity stuff. He's a senior commodity strategist for Bloomberg Intelligence from that commodity capital known as Miami Beach, Florida. Mike, what's going on with WTI crude oil? Again, John Tucker and I, we're happy to see this thing go south, but what's driving it?
Well, it's going lower, and I think you mentioned the national average gasoline price. It's going to $2.86. I wrote about that about 3 months ago. That's the price, the average price for the last 20 years. It's probably just a matter of time. The bottom line for crude oil is the high price cure is kicking in. It went up too much. It's incentivized plenty of supply and plunge in demand. And now you can narrow that down to the exact areas. Well, that's concentrated. The bottom line is most of it's coming from the U.S. and Canada, excess supply and declining demand from China. And we heard today OPEC's trying to curtail. You know, they've been cutting back on production for a while, but it's just a matter of time that comes back on. But crude oil is doing what it naturally does, almost always does. It's the most autocorrelated commodity, and I think it's just a matter of time it gets to 40. Now, most people have heard me say this on the show for at least 2 years. Yes, I have been early. If I was a trader, I would have been stopped out. But natural gas has already done it. Corn's already done it. And basically, it's the #1 rule of commodities. You always basically have to get your cost of production. And in the U.S., that's between 50 and 60 a barrel, actually including Canada, and typically have to get below that level. So the bottom line I'll end with is now we're at the point that as we see the U.S. stock market starting to correct a little bit, if it just has a little bit of normal reversion, it should drag all the commodities with them, with the exception of gold.
Okay, let's talk about the fundamentals. Slowing economies in the U.S. and China. How does that figure into the mix?
Exactly. It's a key part of it. The key thing I like to refer to, John, is going to that Chinese 10-year note yield, the CGB. It's 2.13%. That's about 170 basis points below the U.S., typically trades at a premium. That's a sign of severe deflationary forces out of China. So sometimes you can't really believe their data, which is turning negative. Obviously, it's a very autocratic-led country, but you can't really mess with the yield. And the thing is, the Chinese government have been trying to make yields go higher, according to Bloomberg Intelligence analysts. So that, to me, is a sign of weakness out of China. We have seen declining demand for imports of of crude oil out of China, and then you have excess supply out of OPEC. Their reserves, or their excess supply in reserves, are about 6 million barrels a day. That's comparable to the U.S. excess of supply of liquid fuels and crude oil from the U.S. and Canada. It's about 6 million barrels a day. And to put that in context, our excess of liquid fuels supply versus demand before COVID, around 2019, it was around 2 million barrels a day. The trend is just clearly bad for crude oil, but it also has pretty good companions from the #1 source of heat and electricity in the U.S. And fertilizer in the U.S., and that's natural gas, which has dropped to well below its cost of production in the U.S.
Hey, Mike, since I was a kid, I mean, OPEC's been the driver of supply and the largest, contributor to the price of global crude oil. To what extent does, now that the U.S. is a net exporter for the first time ever, does the U.S., the energy guys in the U.S., did they talk to OPEC? Did they coordinate at all? Or is there just nothing there?
Well, I think they're grateful that OPEC's keeping prices higher, as not so much grateful, but as was partly because of Russia's invasion of Ukraine. That boosted all commodities, particularly crude oil, but most notably the grains in the U.S. And I just came back from the grain belt. It's the biggest crop ever. They planted fence post to fence post, partly because prices were so high. They had profit incentive. So now prices are declining towards those cost of production. Same with crude oil and natural gas. It pumped prices so high, it brought in the supply, and it's heading lower. So that cartel that was somewhat significant, up to 35, almost 40% of total global supply just 12 years ago or so, is now less than 30%. It's declining, partly because it kept prices too high, and it's accelerating that process of finding alternatives, i.e. ethanol, and technology. It's accelerating that process of technology replacing petroleum. I mean, I drive an electric car, and that's part of the key forces of deflation out of China. Virtually all renewable products, EVs and solar panels and batteries, the rest of the world has to put tariffs on those products, so it's going to hurt their domestic products because they're so low. They're just collapsing. This ability to generate energy, and that used to be from petroleum, from technology, is accelerating.
Can we finish with the only commodity that has a PhD in economics? Copper.
Yeah, copper going lower. So the way I look at copper right now, John, is its price about $4.10 a pound. If you overlay that with the bond yield in the U.S., which Lisa mentioned earlier is 3.79, and I just mentioned in China is 2.13, that's where copper's going. I think it's going back to 3. And it put in a pretty good peak this year at $5.20, but it's on the back of massive speculative excesses, similar to Bitcoin, and they're all heading lower. So copper is a significant mean reverting commodity. And also just look at China. If you see China's bond yields maybe starting to tick higher, and China demand pull going up, but they're all heading lower. So I think copper's got a date with about $3 a pound after making a new high at 5.20. But in the big picture, copper will probably continue to outperform crude oil.
And gold, still buyer?
Oh yeah, well, it's still bullish. I think gold's outperforming everything. I'll probably be publishing tomorrow my gold crosses deck, which compares gold to everything. And the key thing to worry about with gold is on a 1, 2, and 3 year basis, it's beating the total return of the S&P 500 that's been driven by AI. That's not a good sign for the global economy. So to me, gold is just a matter of time. It goes to $3,000 an ounce. It might have a little bit of a back and fill, particularly if the U.S. stock market drops a little bit, but it's indicating the great reset's kicking in. Gold beating virtually every commodity and beating the stock market is, to me, a sign of that global recessionary trajectory that you can really get fuel from as you look at Chinese government bond yields dropping to 2.13%.
Hey, Mike, 30 seconds, just real quick. I saw on Bloomberg News story that Andreessen Horowitz closing its Miami office. Do you think Miami's peaked?
Yeah, well, it's overdue for certainly some bumps in the road. I'm hearing condos are a little bit high, but I think the whole country's housing market is just doing that. And the #1 factor to really drive that is this pretty high U.S. stock market.
All right, Mike, thanks so much for joining us.
Does that mean he's coming back here?
No, he's never coming back. He was like one of the first guys who bailed. Mike Malone, that's why he's so smart. He was just ahead of the curve, as he always is. Mike Malone, senior commodity strategist, Bloomberg Intelligence, formerly of like high-cost Connecticut. Now he's down in a condo in Miami. The kids are gone. He booted them out, living the good life that he deserves, he and his wife. So good for him. And again, he was literally, March 13th, boom, the 14th, he was out of here in 2020. He knew what was going on. We're going to have more coming up. S&P 500 up 10 points. This is
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, looking at Dollar Tree right here. Dollar Tree shares fell the most in more than a decade after the chain lowered its full-year guidance as its higher-income customers also began to pull back on spending. Boy, the Dollar Tree season that really is a comment about the consumer. Let's break it down with Jen Bartash. She's a senior retail analyst at Bloomberg Intelligence. She's down in Princeton office for Bloomberg Intelligence. Jen, what's Dollar General? What are they seeing? What's Dollar Tree telling you about kind of what we're seeing out there in retail land?
Yeah, good morning, Paul. When we look at Dollar Tree, it's really a little bit of a continuation of the conversation we had last week with Dollar General. And that's that the consumer is a little bit worse off than expected. I think part of the issue with Dollar Tree is that for their namesake banner, the Dollar Tree stores, their core customer is a little bit higher income. It's that middle level income to slightly higher income consumer. And yet that consumer is pulling back as well, which is really what's sparking a lot of the concern and pulled down their guidance for the year.
What are some of the specific concerns? I don't want to say, I hate that word, idiosyncratic. But go ahead, Jen.
Yeah, well, if you think about Dollar Tree, really their strength is things like party supplies. It's about seasonal decorations, things where people are spending a little bit on discretionary items. And so if we're seeing the middle income consumer pull back from that, that becomes a concern that they're really translating their behavior to more essentials-based shopping. That's something we've seen in low-income households for a while, but if it's moving up the chain in terms of household income, that just signals a little bit of extra weakness that we need to keep an eye on.
How much of this, Jen, is you're an analyst, you see a broad swath of retail companies out there. How much of this is kind of the overall consumer and maybe some challenges that the consumer's feeling versus issues specific to Dollar Tree in terms of execution?
Yeah, so Dollar Tree has done an okay job with executing some of their strategy. So part of this, is definitely the consumer. Yet they, with regards to EPS, they had, a big 30-cent impact on EPS from, liability claims adjustments. They have other things that are impacting their outlook for the rest of the year that are a little bit more perhaps self-inflicted. I think one of the concerns that I see when I look at Dollar Tree is that historically, it's been a chain that has held up better because most of their sales were coming from discretionary items, which are higher margin, that sort of thing. Their consumables mix, or the amount of sales they had from consumable items, tipped over 50% this quarter. So that just signals that people are going more to those essentials categories, and that's not necessarily a good thing for Dollar Tree.
Did they get the memo on like mopping the store once a month or adding cashiers, just like improving the customer experience?
They've been working on improving the customer experience. They've been doing a lot of store renovations. One of their biggest initiatives is to go to this multi-price point type thing where they have items that are more than $1.25. And in order to put those into stores, they kind of do a renovation, or they get those stores ready to embrace those higher priced products. But that's only in 1,600 stores at this point out of the 8,000 or odd stores that they operate. So that rollout's going a little bit slowly, but it is a little bit contingent on fixing some of those back to basic type things that you just mentioned.
So how about the stock here? Dollar Tree down 19% today, 53% year to date, trading at about a 10 PE. Given where this company historically trades and maybe some of the peers, is 10 times a place where you think investors might get interested, or these stocks typically can go even lower?
Well, I would say that right now Dollar Tree's at an interesting juncture, just because they did announce a strategic review of the Family Dollar business that could include a sale. And so they're looking for ways to optimize growth across the business. So the multiple right now, I think, reflects some of the uncertainty with regards to what the future is going to look like for Dollar Tree. They are doing things with the Family Dollar chain. They closed over 650 locations so far this year. There are things that they're doing to try to improve that. But with regards to the valuation, Paul, I think we're still a little bit of a wait and see as to what the outcome of some of these reviews are.
Strategically, is there any more coming together of these types of stores in the future?
Well, it will be interesting to see if they try to sell the Family Dollar, who actually will buy it. Back in 2014, when they acquired the chain for about just under $9 billion, Dollar General was one of the other bidders for Family Dollar. Although with the way that Family Dollar has not evolved and sort of lackluster performance, it's hard to envision who a potential buyer might be. So, I think right now the focus is on, can you make the store base that is still there as productive as possible?
All right, Jen, thanks so much for that. We appreciate getting some of your time. Jen Bartasha, she's the senior retail analyst at Bloomberg Intelligence. She's down at our sprawling campus in Princeton, New Jersey. Have you been to the Princeton office?
They don't let me out of this office, actually.
That's what
They don't let me out of here to go home.
It is a nice office down there in Princeton, beautiful Princeton right outside. And that's where Bloomberg Intelligence had its roots back in the day. Now we're kind of all over the world, literally, with 400 analysts and professionals.
And who hired them all?
I don't know. We had some good hiring back in the day.
He?
We had some good hiring decisions back in the day. And this was in 2009 when the world had just come through the great financial crisis and no one was investing. And Mike Bloomberg said, let's build a research department. I mean, who does that?
And thus, Paul was hired.
That's did David Dwyer and a bunch of others, and here we are. And Alex Seminova coming in soon. All right, looking at the markets here, S&P 500 up 0.3%, the Dow up 0.5%, NASDAQ up 0.4%, so moving a little bit higher here. 10-year Treasury yield, it's off 4 basis points, 3.78%. Mortgage rates, 6.43% on a 30-year fixed. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, lots going on here. The market's trending higher here. We're going to kick it off and talk to Alex Seminova. She covers all the equity markets for Bloomberg News. She'll tell us what's happening out there in the marketplace. Will Hoffman, Bloomberg Intelligence Senior Rate Strategy. The Bank of Canada cut some rates here today, so that's interesting. We'll get some thoughts on that. And, of course, we'll take a look at some of the economic data and what that means for this U.S. Federal Reserve as September 18th is upon us very soon. Lindsay Dutch, Bloomberg Intelligence consumer analyst. Dick's Sporting Goods had some pretty good numbers there. They boosted their annual outlook, so people are buying sporting equipment. So we'll get the latest there. Margie Patel, she is at Senior Portfolio Manager, Allspring Global. She'll give us her market call. So a busy hour coming up as these markets move higher. Let's kick it all off as we do in the 11 o'clock hour.
Thanks very much, Paul Sweeney. Indeed, lots going on, lots of moving parts to this market today. The Dow, the S&P, NASDAQ, all advancing after yesterday's swoon. Best level of the day right now on the S&P, up 19.55.48, where we stand, up by about 0.3%. Treasury yields tumbled after data showed a further slowdown in the U.S. labor market, lifting Wall Street bets on Fed rate cuts. Stocks are rebounding as NVIDIA paces gains in chip makers. NVIDIA right now up 1.5%, the Dow up 202, up 0.5. S&P, as I mentioned, up by about 0.3, while NASDAQ higher now by 0.4%. 10-year 3.78%, with the 2-year that's yielding 3.78%. Spot gold up $4.50 the ounce to $24.97, up 0.2%. And a further retreat today for crude oil. West Texas Intermediate below $70 a barrel now, 69.81, down by about 0.8%. NVIDIA now facing subpoenas from the Justice Department as a probe into possible antitrust violations intensifies. Bloomberg News first reported on it in June. Mandeep Singh covers tech for Bloomberg Intelligence. He was interviewed this morning on surveillance.
Right now, the question that they are looking at is how has NVIDIA allocated their chips in a market that everyone knows is undersupplied? There is more demand for NVIDIA chips than they can supply. So how have they allocated it?
Bloomberg's Mandeep Singh interviewed this morning on surveillance. A judge has ruled Johnson & Johnson owes more than $1 billion in damages after breaching its pledge to prioritize 2 surgical robots it acquired when it bought Auris Health for $3.4 billion. J&J shares, they're up today by just about 0.3%. Among the names reporting today after the close of trading, we will be hearing from Hewlett-Packard Enterprise, HPE down 1.5%. Recapping stocks higher, S&P up 22, up by about 0.4%. I'm Charlie Pelleton. That is our Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate that. We got John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. We're in your dashboard, Apple CarPlay, Android Auto. We're pretty much everywhere. We got this technology thing kind of nailed down. And if you're in New England, we want to welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the FM dial. Bloomberg 92.9. Green on the screen. Charlie Pello's just reporting here. S&P up 0.4%. Let's check in with our good friend Alexandra Semenova. She's Bloomberg News. She covers these markets for us. Alexandra, what are you looking at?
Great to be on with you guys. So lots of big names on the move today. The first company I'm looking at is Lyft. Shares are up about 2.7% right now. This is after it announced some measures that it'll take in an effort to turn profitable. It is going to sell off some of its bike and scooter businesses and eliminate 1% of its workforce. It had about 3,000 employees as of the end of last year. Now, they didn't announce exactly who they're going to sell these bikes
Wait
and
a second, the
scooters
Lyft
to.
scooter, is this like you just rent a Lyft
just leave it, it's like
scooter?
a bird.
Or it comes with a driver?
Yeah, no, apparently you rent.
Yeah, you just rent them.
I'm kidding.
You rent them, but
Bird. We don't have that in New York. We have everything else, but we don't have that.
we don't. I mean, that has been a tough corner of its business for them, not making a lot of money. Hence, they're trying to kind of get rid of some of those. And it's going to incur about $34 million to $46 million in restructuring-related charges. That's going to happen in the third quarter. It did announce some really ambitious profitability targets in June for the next 3 years. So it's going to try to, compete with Uber. It hasn't been doing as well. The stock is down about 24% this year.
Got a market cap, let's call it round up, call it $5 billion. Uber's got a market cap of $150 billion. I mean, I did not see that coming when these two companies IPO'd, how they would diverge so much. What else you got?
Yeah, also taking a look at Nordstrom. So the Nordstrom family said that it is going to try to take their namesake, a department store chain, private in a $3.8 billion deal. Eric and Peter Nordstrom, those are the great-grandsons of founder John Nordstrom, said that they have been exploring ways to take the company private. The offer of $23 per share is an effort to kind of take it away from the glare of public markets. This has been something that a lot of department store chains have been doing as they broadly have been grappling with slowing consumers. But they tried to do this in 2018. It wasn't successful. So not clear that shareholders will approve of this.
Passed by the new Nordstrom's on 57th Street on Billionaires Row.
Yep.
I don't think I've ever seen anybody in there.
Is that right?
It's always quite quiet in there.
Is it?
Even though they invested so much money into it, they always have a DJ. It's an enormous store. They really tried to do that, in-person retail experience, but it hasn't been successful.
I mean, I'm looking at Eric Nordstrom. He owns 2.2% of the stock, Whoopi. Peter Nordstrom owns 2% of the stock. I mean, it's not like, and there's no control stock. It's not like these guys got a lot of skin in the game. I'm not sure how this is going to play out, so we'll keep an eye on that one. Anything else?
Yeah, also taking a look at Dick's Sporting Goods. Interesting, the stock is down right now about 7%, even though they, announced some a pretty upbeat outlook. They sidestepped some of the struggles of their retail peers. They raised their full-year forecast for sales and adjusted earnings. They now expect that comparable store sales, which is one of their key metrics, will rise 2.5% to 3.5% in 2024. Their CEO said that customers are holding up very well and also emphasized that they're prioritizing outdoor and team sports, even as consumers broadly still struggle with higher interest rates.
Have you ever played pickleball?
I have not. I haven't gotten into it.
Good Lord, no.
Look at
me.
0 for
You think
3
I
here.
play?
I'm just going to assume Charlie Pellet hasn't played it. So that'd be 0 for 4.
We need a Bloomberg radio team pickleball
Yeah,
outing.
it's the rage. It's the rage. I don't know if that's impacting their numbers, but Alex Semenova, thank you so much for joining us. Alex, she covers all the equity markets for Bloomberg News. We appreciate getting a few minutes of her time. I saw earlier today, John, and I don't know if it caught your attention, the Bank of Canada cut its key interest rates a little bit ahead of the U.S. jobs report we're going to get on Friday. Kind of continuing with what we've seen from some other central banks cutting interest rates, and we're waiting for the Fed on September 18th. Will Hoffman, he does this rate stuff for a living. He's senior rates strategist, Bloomberg Intelligence. I'm just glad we hired him because now we don't have to talk to Ira all the time. I mean, enough already. Hey, Will, just a little change is nice. Will, thanks so much for joining us here. What'd you make of the Bank of Canada move? Is that kind of expected and in line with what we've seen from like the Bank of England and the ECB and so on?
Hey, absolutely, and thank you for having me. It's something that was fully priced by the markets, including a little bit of a premium for a 50 basis point cut, which did pop up in the Q&A with Governor Macklem just a few minutes ago, but it was dismissed relatively quickly. The easing cycle down to a terminal floor of about 2.5% by end of 2026 is what we're looking at for the Bank of Canada from a policy perspective. This meeting met expectations, and there wasn't a whole lot of new information from either the statement or the remarks from Tiff Macklem. It was met expectations and evolving in line with their forecasts.
So can Fed watchers divine anything from our neighbors to the north?
So it's a bit of it's something that we saw just after the policy reaction is Canadian market moves are often completely overwhelmed by U.S. rate moves. I mean, we rallied into the Bank of Canada announcements and then subsequently sold off a touch as it didn't meet dovish expectations. But then you get a 10 a.m. JOLTS print and an extra 5 basis points rally, or 5 basis point rally on twos up north. Again, it's not something from a rate policy perspective that's very informative, but the one takeaway I think people in the U.S. need to get ahead of is the likely divergence between rate policy and balance sheet policy for the Fed here is QT is likely to continue at least into the first quarter of next year, potentially a little bit further depending on risk preferences from the FOMC. But we've seen it in Canada with QT running for quite some time and now 3 consecutive meetings of rate cuts.
So, Will, what are you and Ira and the rate strategy team at BI, what are you guys looking for from this Federal Reserve? I guess, Friday will be an important day with the jobs data, but how do you think this Fed is kind of moving these days?
Absolutely. They teed us up for a rate cut at Jackson Hole. I think that's not new information and was as clear as it could have been apart from a pre-announcement of the policy from Powell. The question, as has been highlighted from Bloomberg Economics and many of their speakers, is it 25 or is it 50? And we're in the 25 camp. We don't think the economy is weak enough to justify a 50 basis point start, but after today's JOLTS number and a potential for a downside miss on non-par payrolls later this week, couple that with a weaker than expected CPI, PPI, implying lower month-end core PCE and a weak retail sales print the day before, that justifies a 50 basis point cut. But again, it's not what we foresee, but there's absolutely a path to get there. I think we're flirting with even odds on a 50 basis point cut in short rate markets just after that 10 a.m. report. So, yeah, I think Friday is really going to be the deciding factor for 50 or 25, really regardless of what CPI comes in at later in the month.
Well, your impression, well, let's see, twos 379, 10-year 379. Look at that, dead flat. Your impression, what does it mean? Do you care?
It means we have to redo our year-end forecasts. That's for certain. Those are just about right there. We've been flirting with a positive 2/10 curve. We were there for a cup of coffee during all the excitement earlier last month, and now we're likely to see additional steepening led by the front end of the curve as policy cuts are realized.
We call that bull steepening, right?
Yeah, I don't know.
Indeed, yes. Bull steepening. For the opposite, you'd have to be wagering on 10-year yields to sell off, and that could come from any sort of term premium expansion or other factors to drive that.
All right, Will, good job, man. Appreciate it coming on. Will Hoffman, Bloomberg Intelligence Senior Rate Strategy Associate. He's a young guy. Ira hired him. He's doing pretty well. You got some good young people down there.
With us, everybody's younger.
That's
so.
true. That's true.
At this point.
But this kid's like fresh out of University of Delaware a few years ago, which is, by the way, awesome school. We hire a lot of great kids out of University of Delaware. They're doing a good job down there. And you know who's a proud graduate of the University of Delaware? Liz Ann Saunders.
Oh, no kidding.
Yeah.
All right.
Yeah, so that's pretty cool. Let's look at Dick's Sporting's Good here. Lindsay Dutch, Bloomberg Intelligence Consumer Retail Analyst. Lindsay, talk to us about Dick's Sporting Goods. John's a big, sportsman here, so I mean he's in there all the time. But what can you tell us about Dick's Sporting Goods?
Yeah, so it was solid second quarter results this morning. The comps were a little bit on the easy side, and the guide moved up, but the market seems a little bit disappointed in, the guidance raise, maybe expecting a little bit more on the 2Q beat, and given, strength of demand that Dick's seems to be seeing through the second quarter.
How do they differentiate themselves? I mean, the batting cages? Am I going to be able to go to Dick's now and watch sports on the big screen and order a beer?
Maybe not quite that far, but you can definitely go into some of their new House of Sport locations, and they have a lot of really cool things, rock climbing walls, tracks, and different sort of experiential adventures that you could sort of go on. But I think that is a big piece of their differentiation. They've done a really good job of curating an assortment that's not, solely dependent on Nike. It crosses a lot of different brands. They have their own vertical brands that have done really well over the past 12 to 18 months, especially with pressure on the consumer. And then they are doing these store remodels. They're bringing experience in the store, and they're really trying to train their shopper that they are experts. They know what they're doing. They know what equipment you need for, competitive sports, recreation sports, and even if you're just looking for athleisure wear.
I mean, I kind of thought the numbers were pretty solid. Guidance was pretty solid. I'm surprised the stock is down, as much as 10% today. How do expectations for a retailer in an okay economic environment, did the expectations just get way ahead of themselves?
Yeah, so I agree that the reaction seems a bit overdone here. I mean, they put up a 4.5% same-store sales comp. That is really great. Of my coverage within hardlines, that's the best I've seen for the second quarter. So really strong results. Again, the comp was a little bit easy, so we can say, maybe isn't quite as good as those headline numbers say, but demand appears really strong. I think the guidance, could be on the conservative side. We're still thinking about, the consumer and headwinds there for the fourth quarter, which is so important for any retailer. But when we look at it, they're thinking average 1% growth in that back half, and that's pretty solid. When you think about the economic backdrop, you think about tough compares to last year, and if it's on the conservative side and demand is strong, we could see better than that.
Is it just a high-end consumer, or everybody comes in the door?
So they do have a higher income consumer base in general, but they have seen transaction growth and higher average ticket in both the first and the second quarter. And I think part of what they're benefiting is, consumers this year, I think that consumers are more selective and more value-focused than last year, and that includes higher income. But for Dick's, if you think about sneakers, kids going back to school, that is a discretionary item that is considered a must-have. And I think Dick's benefits from their curated assortment across a wide variety of brands. That footwear, gets people in the door, whether it's for sports, recreation, or back to school. And I think once that customer is in the door, they see that there's a lot of other things in the store that may be of interest, and that is really driving strength.
All right, Lindsay, thank you so much for joining us. Lindsay Dutch, Consumer Hardlines Senior Analyst, Bloomberg Intelligence from Princeton, New Jersey. That's where a lot of this, again, smart
Do I have to
people
get like a special uniform and stuff and sneakers for pickleball?
I don't think so. No, I just see
go
people,
as
and
is.
you don't have to wear the dress whites or anything like you do at Wimbledon. It's a little less formal. But if you talk to the tennis purists, they're upset because it's kind of overtaken tennis, like at the local.
Boo-hoo.
I mean, they're taking tennis courts and converting them into pickleball courts, and the tennis people are like, wait, we've been here for a long time. But everybody seems to be playing pickleball. Now, my question is this just kind of racquetball from the 80s? You know what I mean?
Right.
People build all those racquetball courts in the YMCA's, and then nobody plays racquetball.
Was this an event at the Olympics? I mean, it says officially sanctioned as
I
a
don't
real
think we're
sport.
at that point yet. But the pickleball courts where I am, people are using them all the time. Now they're taking over tennis courts. So if you're a tennis aficionado, you're a little upset there.
You don't think it's a fad?
I don't know. It's big. I mean, it's just everywhere. And I think what's good about it is pretty much anybody can play. I mean, you don't have to be athletic, and even you could play. And the doctor's offices are like, this is great for our business because these people are blowing out knees and ankles and things like pulling hamstrings and everything. So if you're a local physician, I mean, it's good for business. All right, we're gonna have more coming up. This is Bloomberg. Good morning.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg on this JOLTS Wednesday. The Dow, the S&P, NASDAQ, all advancing. S&P right now holding on to an 8-point gain, up by about 0.1%. We got the Dow up 123 now, up 0.3%, while the NASDAQ Composite Index is up 28. That is an advance right now of 0.2%. Treasury yields tumbled after data showing a further slowdown in the U.S. labor market lifted Wall Street bets on Fed rate cuts. Stocks also rebounded as NVIDIA paced gains in chip makers. NVIDIA now up by 0.7%. 10-year at 3.78%. 2-year 3.79%. Spot gold up $4 the ounce, an advance now of 0.2%. Spot at $24.97 the ounce, while West Texas Intermediate crude right around $70 a barrel, down another 0.4%, 70.08 right now on WTI. Sources tell Bloomberg Targa Resources, an energy infrastructure company, has rebuffed informal takeover interest from larger rival Williams companies in recent months, in another signal of sustained appetite for consolidation in the pipeline industry. Right now, we have got shares of Targa down 1.4%, Williams down 2.5%. Recapping stocks holding on to gains, S&P up 7 now, up 0.1%. The 10-year 3.79%. The 2-year also at 3.79%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. We got John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And up in Boston, you can listen to us at 92.9 FM. How cool is that? That is a big signal up there. We need some perspective on this markets. After yesterday's sell-off, got a little bit of green on this screen here. People are trying to get a sense of how do you factor in what was a decent earnings cycle for most of the S&P 500. Plus, with a Federal Reserve that is likely to begin cutting rates, how does that factor into the outlook here for risk assets? Margie Patel, she's got a lot of perspective, a lot of experience. She's a senior portfolio manager at Allspring Global Investments, joining us from Zoom from Boston. And again, if you're in Boston, our new home is 92.9 FM in Boston. Margie, thanks so much for joining us here. How do you piece this all together here? We're pretty much through the earnings season. Investor conferences are kicking in high gear here in September. September 18th, the Fed is going to meet and presumably start lowering rates. So how do you put all that together and what comes out for you?
Well, I think right now we're in a period of cross currents because the overall earnings reports for the quarter were once again pretty good. However, we did have some slight weakness from expectations for some of the large tech companies, in contrast to the previous quarters where they surprised on the upside. And since this group was so heavily overowned, frankly, it was really due for correction. And we've seen that over the last, really since the end of July into yesterday, where you just had this cascade of all the techs going down and other economically sensitive sectors that have done really well. So I think it's just really adjusting, waffling around, waiting for the Fed to once again come in and be on the late side, frankly. And I think now that we have a news gap. So this is a seasonal slow period of the year. And I think that by the end of the year, we should have a strong December and a strong rebound after the election, really no matter who wins, because that's just really what happens in election years. So a little more waffling around. And then I think maybe in December, we'll see the market move up.
I got to get this one out of the way. Put your Bond hat on for a second. Did you throw confetti in the air when the curve disinverted between 2s and 10s this morning?
Well, it's really amazing how the curve has come down, and we're just about flat now, which I think is a step. And really, to me, it says the market is making the adjustment to interest rates that the Fed really should be doing. In other words, pushing down short rates compared to long rates. So to see the 2-year come down so much over the course of this year compared to the 10-year and have both of them really well under 380 is pretty encouraging. It says that we are in the middle of a period of very, very tight money, and all we need is the Fed to come in and provide some stability. I think the Fed is really the one who's behind the curve. The market's really doing what the Fed should be doing by bringing rates down and putting a little bit of a floor under how big of a correction we'll have.
So, Margie, are you a proponent of kind of moving away or de-emphasizing or diversifying away from some of the big tech names into this diversification trade, if you will, the rotation into maybe some smaller caps, some maybe some lower valued sectors? Is that something that interests you?
I'm a little lukewarm about that, because you did have some of those sectors like small caps have a big jump up in price just because they had really gotten so out of whack compared to the rest of the market. But if you think we're in a period over the rest of the year of, frankly, slow economic growth, maybe a GDP of 1%, 1.5%, something like that, it's really hard to see how some of those more value companies that have slow growth markets are really going to continue to shine. So I think you really have to get through this volatility period and then look for companies that should have higher than average growth, higher than the GDP backdrop, let's say only 1.5%. So I think it's a short-term move. Long term, I still think will be with the larger companies that have a sustained growth path for cyclical growth.
NVIDIA 108.40-ish, is that an entry point for investors? Your thoughts just on the tech space specific to NVIDIA?
Well, certainly you've had a huge correction there. And if you thought it was rather highly priced at 140, very high PE, certainly with about a 30% or more adjustment in price, it looks much more fairly priced compared to its growth. So I would say that it's certainly a better buy here than a sell at these levels.
Fixed income, I see the best performance is in high yield. Is that something of interest to you, or is it spreads too tight?
Well, spreads are tight. Double Bs are a little over 2 basis points more than treasuries. Single Bs maybe a little over 3 percentage points, which is narrow historically. However, defaults are very low. Defaults are under 4%. And if you look where we are in the credit cycle, the Fed is now, hopefully one of these days, going to be on an easing cycle where short rates come down. So that says to me that's a pretty good backdrop for high yield. The big negative is, of course, the yields aren't very high. You're looking at, say, 6 to 7.5% for most issues. But really, if you think the economy is going to be growing very slowly, which I do, 1.5%-ish, say, then that implies that the growth in the equity market over the balance of the year may well be low to mid-single-digit total return from here, which would really be about comparable with what you get from high-yield bonds. So we may actually have high-yield bonds running neck and neck with equities over the next few months. So I think they're pretty good, especially if you are more looking for income rather than capital appreciation.
All right, Margie, thank you so much for joining us. Always appreciate getting your thoughts and perspective. Margie Patel, Senior Portfolio Manager, Allspring Global Investments, joining us from Boston on Zoom. And again, if you're listening to us in Boston, our new home is now 92.9 FM in Boston. Let's take a look at Nordstrom. The Nordstrom family bids to take the chain private for $3.8 billion. Stock pretty much unched on the day, so not a big deal here for most shareholders. Stock is up 23% year to date. It's got a market cap of about $3.7 billion. You throw in the net debt, it's a little over $7 billion total enterprise value. Let's check in with Mary Ross Gilbert. She's Bloomberg Intelligence Senior Equity Analyst covering the retail space. Mary Ross, thanks so much for joining us here. What do you make of what the Nordstrom family members are suggesting here? I know this has been in the news for a while, but where do we go from here?
Yeah, so the Nordstrom family has been wanting to take the company private for some time, right? We've seen this iteration before, but this time partnering with the Mexican retailer El Puerto de Liverpool, they're in a good position in terms of coming up with the financing, because they're going to pony up about $1.2 billion in cash in addition to rolling over their about 10% stake in the stock. And of course, the Nordstrom family combined, they own about, a third of the shares. So you've got 43% wrapped up. They do need 2/3 approvals. We just need to get another 23 to 24% on board. And you look at the price, there's really no premium here. And they're basically saying, well, if you look at the time that we proposed this transaction, which was back in March, the stock was trading much lower, somewhere around 17. So this is really a premium to where the shares were then, and it's about a 35% premium. But if you look at how the stock has traded over the last 5 years, it's pretty much close to the average price. And over the last 10 years, it's at a steep discount, like 41% discount, over the last 10 years. So yeah, there's not a premium. Could another buyer step in here? It's possible, but trying to piece together a transaction could prove onerous. And it's going to, involve debt, as we know, but not as much incremental debt. The company already has about $2.6 billion, so they'll probably have to bring on another $1.8 billion to be able to complete this transaction. Right. And of course, the transaction is contingent upon that deal getting done. But with Nordstrom, what really stands out versus the other department stores, and of course we know that the Macy's proposed buyout has gone by the wayside at this point. With Nordstrom, you've got a fast-growing off-price segment, and that's what's really exciting here. And their comp sales were up over 4%. Their total growth was up 9% in the second quarter. And if you look at their full-line stores, the sort of traditional department store, they were up almost 1% on a comp basis. But if you look at their peers, they were all down, anywhere from down 3% for go-forward stores for Macy's to down 5% for Dillard's and Kohl's. So Nordstrom sure looks like they're in a better position. They're also much smaller, only 93 stores versus close to 500 department stores over at Macy's, which of course that's why they're closing 150.
Let me just ask you, when you're a company and you have problems and you turn to deal making to try and solve those problems, what does that say? You've got about a minute left.
Yeah, so in this case here, I think they're employing a number of new strategies, let's say with the full line store, and with off price, I think they're off to a good track there. And big expansion. They're going to be opening like 22 rack stores this year, and I think they're going to continue that pace going forward. So I think that the idea that they don't have to be under the quarterly lens of investors is probably a relief for them.
Right. All right, Mary Ross, thanks so much for joining us. Mary Ross Gilbert, Senior Equity Analyst covering the retail space for Bloomberg Intelligence. She's based out there in Los Angeles. Nordstrom, some of the family members offering $23 per share in cash to take the retailer private for $3.8 billion. News crossing the Bloomberg terminal, John. The U.S. Securities and Exchange Commission is ending a high-stakes legal fight over hedge fund and private equity fee disclosures, a setback for Chair Gary Gensler's push to bring more transparency to the industry. The regulator did not act by a Tuesday deadline to ask the Supreme Court to review or to revive new disclosure requirements for fees charged to investors. And that's according to a person familiar with the matter who asked not to be identified discussing the litigation, but a little bit of a setback for Mr. Gensler. I guess good news on the margin for hedge funds and private equity.
hedge funds, but what about investors? I mean, I can hear Arthur Levitt saying this is a loss.
This
for
is a
investors.
loss for the investor out there. Arthur Levitt, certainly a champion of the individual investor, former chairman of the SEC. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the S&P now lower, a turnaround since our last update. The S&P down 3 points right now. Little change, down less than 0.1%. The Dow holding on to a gain of 0.1%, up 62 points. NASDAQ, though, in the red, down 25, a drop now of 0.2%. Treasury yields tumbled after data showing a further slowdown in the U.S. labor market lifted Wall Street bets on Fed rate cuts. The 10-year 3.79%, with the 2-year that's now yielding 3.79% as well. Spot gold up $1 the ounce, almost $2 the ounce to $24.94, up by about 0.1%. West Texas Intermediate crude holding right around $70 even a barrel. Crude extending its decline down another 0.5%. The Commerce Department reports the trade deficit in goods and services is now the widest in 2 years as the threat of a dock workers' strike looms. And with that story, here's Bloomberg's Vinny Del Giudice.
Industrial supplies and consumer goods led imports higher in July. Many American businesses are stocking up as dock workers consider a walkout. The busy ports of Los Angeles and Long Beach, for example, reported their third strongest month ever in July. The data also show U.S. exports edged higher. Vinny Del Giudice, Bloomberg Radio.
Dick's Sporting Goods is raising its full-year forecast for sales and earnings. The stock, though, selling off. Shares of Dick's Sporting Goods down now by 6.7%. Among other retail news, the Nordstrom family offering to buy its namesake department store chain for $23 a share in cash, with plans to take the retailer private for $3.8 billion. And Dollar Tree has lowered its full-year guidance as consumers remain cautious in their spending. We've got Dollar Tree shares plunging today by 19.1%. Recapping, stocks are mixed. The Dow up 0.1%, S&P down 0.1%. Both the 10-year and the 2-year now at 3.79%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. YouTube podcast, that's where you search. After the close today, we're going to get some earnings from Hewlett-Packard Enterprises. That's a computer networking and hardware company. The stock's off about 2.5% today, up about 9% year to date. Let's get a preview of what we might see from HPE. Woo Jin Ho joins us, senior technology analyst for Bloomberg Intelligence. He joins us via Zoom from Princeton, New Jersey. Wooj, what's the story here for Hewlett-Packard Enterprises? Just tell us kind of what the company is today and what you're looking for.
Yeah. So, hey, thanks, Paul. So there's a couple of things, right? It's evolving into an AI server story. Like any other U.S. hardware company, AI has been the focal point for a lot of investors lately. And look, it's been growing quite nicely, but in a very differentiated way. The other thing that I am actually looking for is a recovery on their traditional server and storage businesses. That's been just trudging along from a cyclical downturn, and I do expect some improvement over there as well.
Hey, real quick, the Juniper Networks acquisition, where does that stand with this company? Is that all?
Hey, John. Yeah. So the Juniper Networks deal is still on track. It seems as if it's going to be the calendar fourth quarter of 2024, possibly slip into the calendar first quarter of next year. And I actually like this deal. It's a contrarian view, primarily because I do think it is going to help their networking business quite a bit. And also keep in mind, it is a higher margin business. Traditionally, their margin profile is in the low teens, and Juniper is going to tick that up a little bit closer to the mid-teens.
Do we get an update today?
Highly unlikely. They'll probably talk about it's still on track. But I will tell you that, some of the regulatory rulings have from other countries have fallen in their favor.
So, when I think of HPE, I think of, computer hardware, storage, that type of thing. How is Hewlett-Packard Enterprises trying to get some of that AI pixie dust in its stock?
Oh, yes, you picked up the word pixie dust. Look, if you think about HPE, they've actually had a long history of AI and high performance compute business. They made that Cray acquisition several years back, so they do have a lot of supercomputer prowess within their DNA. Now, what they have done was partnered with NVIDIA about a quarter back to provide more enterprise type of AI deals. Now, the one thing I will tell you, Paul, the enterprise has been slower to pick up on AI than where we know that the cloud has, but I do think there is not only a hardware opportunity, but also a cloud opportunity longer term because these AI servers are very expensive.
Their competitors are what? Dell, Cisco? I mean, how does HP differentiate itself?
So, John, from a server basis, it's going to be Dell and Supermicro predominantly. On the networking side, it's Cisco. It's the 800-pound gorilla there. And then also they have a sizable storage business, and it's going to be guys like Dell, NetApp, and Pure Storage.
So for HPE, I see a dividend yield of 2.8%, which in your world, Wooj, not a lot of these companies pay dividends, yet there's cash just cows a lot of them, particularly, the really big ones, Amazons and Apples and things like that. How does HPE position its dividend policy here while still trying to maintain kind of, hey, we're a tech player?
Yeah, so look, they are a cash flow generative company. They should be more cash flow generative going forward after the Juniper deal. The one thing I will say is that I'm not too hopeful that from a capital's returns basis that the dividends are going to grow as strong as one may hope. I think it's more of a function of the stock price coming down a little bit. We have to keep in mind that there is a $26 billion Juniper deal that's coming down the pike. Yep. So they will be a little bit tight on the cash side. So to pay back some of the debt to close the deal, they probably will be a little bit judicious on how they deploy their cash flow.
Oh, kind of out of left field. I don't know. You tell me. They're continuing to pursue their claim against Mike Lynch. He's the billionaire who lost his life along with his daughter in that horrific yacht accident. How is that being perceived, I guess, from a public relations standpoint?
Yeah, from a PR standpoint, look, if we keep in mind how they won the autonomy ruling and then it was overturned, I'm not surprised that HPE is going to go continue to pursue it. It is quite a big sum of money that they're trying to pursue, and I wouldn't be surprised.
Just to remind everybody, he sold his company to HPE, and after they bought it, they looked at it and said, "Oh, the price, we paid too much for it," or I guess.
No, yeah, John, I think there was some financial malfeasance within autonomy where they wanted to reject the bid and go after Mike on that one. And not surprisingly, I wouldn't be surprised if they're going to go after the estate of Mike Lynch just to get back what they believe it's owed.
Interesting story. All right, Wooj, thanks so much for joining us. Wooj Ho, Senior Technology Analyst, Bloomberg Intelligence from Princeton, New Jersey. HPE is a ticker, Hewlett-Packard Enterprises. Again, they're going to report earnings after the close. And again, another one of those technology companies, John, that's trying some way, somehow, to get underneath that umbrella of AI. Get some of the real, if it's real business.
What did you say? Pixie dust?
The pixie dust. Get some of that pixie dust on your PE multiple. Yeah, and double your PE multiple because you're an AI play. That's what you're looking for if you're a technology company. But I think the market's gotten more savvy over the last 6 quarters in trying to identify who really is a real player here and who is not.
Interesting.
So
all right.
Interesting to see. But I mean, NVIDIA has been the name. If you just ask any person on the street, how do you play AI? If they even know what AI is, they'll say NVIDIA. But it's broadened out to some software makers, some hardware makers, storage, as Wooj was talking about here. A lot of dollars being spent. Now the question we're hearing probably in the last quarter or two is, okay, I get you guys are spending a ton of money. What's the return on that investment?
Yeah, and when?
And that's kind of a question that's been asked a little bit more. So we'll stay on top of that. S&P 500 absolutely unched on the day. The Dow's up 68 points. The Nasdaq's down 11 points. 10-year Treasury yields come in 3 basis points, 3.79% on your 10-year U.S. government bond. We'll have more coming up. This is Bloomberg.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Interesting story across the Bloomberg terminal here, John Tucker. The Biden-Harris administration's big bet on Intel Corp to lead a U.S. chipmaking renaissance is in grave trouble as a result of the company's mounting financial struggles, creating a potentially damaging setback for the country's most ambitious industrial policy in decades. I kind of forgot that 5 months ago, President Biden traveled to Arizona to unveil a potential
That was a big deal. A news conference
package.
Standing there with Mr. Gelsinger.
Yeah, $20 billion, and that is now in jeopardy, perhaps. Mackenzie Hawkins joins us, Bloomberg News technology reporter. She joins us. Mackenzie, you reported on this story here. Give us the latest here on Intel and the ability of it to kind of fulfill its end of the agreement with the U.S. government.
So 30,000-foot perspective here, the U.S. government has this $39 billion program to issue grants to chip companies and convince them to do manufacturing on American soil. And Intel is supposed to be the biggest winner from that effort. The package that you referenced that Biden went to Arizona to announce was $8.5 billion in grants and $11 billion in loans, putting aside the 25% tax credits that Intel could maybe get on what could be $100 billion in U.S. investment. So we're talking about massive, massive sums of money here. But all of those agreements are preliminary. And right now, the company is undergoing due diligence and hashing out the finer details of its accord with the Biden administration. That happens to be going on at the same time as Intel is in dire financial straits. The company had a pretty disastrous earnings report last month, sent its shares tanking, the worst rout that it's seen in decades. And now there are a lot of questions looming about whether Intel can actually pull off this big U.S. manufacturing expansion. And given its centrality to what's called the CHIPS Act overall, whether the Biden administration will still be able to achieve its policy goals.
Now, I'm no politician, but if I'm going to head out to Arizona, have a news conference as President of the United States, I would think that somebody on my staff has actually done the due diligence to make sure that Intel, who I'm having a news conference with, is actually going to be able to meet those milestones. Am I too cynical?
Well, the Commerce Department, which is running the CHIPS Act, has actually set up this pretty intentional process from the outset, telling companies, you apply for this money, we reach a preliminary memorandum of terms. That's what was announced for Intel and all of the companies that are part of the program, which include some of the world's leading chip makers, Taiwan's TSMC and South Korea's Samsung. And basically the government is agreeing to underwrite this program. But companies have to go through due diligence in a sort of private equity type model after reaching that preliminary agreement. Then they sign a final term sheet, and then they have to actually hit the milestones on their projects before they receive any money. And the government has the ability to claw back money if they hand it out, but the projects are never fully completed. So there are a lot of guardrails built in place to prevent the Biden administration or the next administration from actually handing out money to a company that may not be able to pull things off, if that ends up being the case with Intel.
Intel's not even sharing all the information, is it?
Well, they're going through a pretty contentious due diligence process right now. The company and the Biden administration say that they're working hard to reach a final agreement, but there are certain requests that government officials have made of Intel that the chipmaker doesn't want to deliver on. And I think the challenge for the administration is such a big part of vetting a project's commercial viability is knowing that they have customers, that there will actually be demand for the chips that they intend to manufacture. And in Intel's case, the picture is a little bit bleak. The company has secured some potential commitments from firms including Broadcom, MediaTek, and Microsoft, but none of those have chosen to go to full production with Intel's facilities yet. Commerce Secretary Gina Raimondo encouraged leading AI chip makers NVIDIA and AMD to consider manufacturing at Intel's Ohio facility, which Pat Gelsinger said could be the world's largest chip making factory if it's fully built out, and neither of them plans to do so. Oh, wow. So this is putting the Biden administration in a bit of a difficult spot, and despite the fact that they haven't actually released any money yet, it could become potentially a huge political liability.
What is the administration saying in terms of any backup plan?
So we have to keep in mind that Intel is just one company that is supposed to benefit from the CHIPS Act. there were hundreds of companies that expressed interest in this money, and the Biden administration has announced investments in the preliminary agreement form of north of $30 billion to around 16 or 17 firms in total. And that includes commitments from all of the world's top chip makers. Intel is one of them, but as I mentioned before, TSMC and Samsung are also planning on producing leading edge logic chips in the United States. Micron, one of the world's top memory chip makers, is building factories in Idaho and New York. So there are lots of companies that are part of this program. At the same time, Intel is uniquely important. The U.S. wants to reach the U.S. wants to reach 20% market share, a fifth of the world's most advanced logic chips, by the end of the decade. Intel's factories are a crucial part of that effort, and the company is also supposed to be the sole intended beneficiary of this $3.5 billion program to make secure semiconductors for the Pentagon. So there's a backup plan insofar as there are other companies involved, but Intel matters a lot.
And presumably this is to create jobs, and it comes at a time when Intel's cutting around 15,000 jobs.
Exactly
so
right.
There you go.
Mackenzie, great reporting. Thank you so much for joining us. Mackenzie Hawkins, technology reporter, from joining us from Washington, D.C. Appreciate that. So Intel, again, another day, another piece of bad news here. And it just seems like, and again, I don't follow the chip business day to day, but it just seems like the technology to some degree has passed by Intel, and they missed kind of the AI wave or evolution, whereas NVIDIA, boy, right
Which
there.
NVIDIA doesn't make chips, they just design them.
Exactly right, exactly. That's my understanding. All right, we've got S&P 500 absolutely unchanged on the day. The NASDAQ off 11 points, the Dow up 58 points. Balance of power with Joe Matthew. He's down there in Washington, D.C. He's going to bring it all together. He gets a great show, bringing us all from Washington, D.C. That's...
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
It's back to the economy, stupid. Welcome to the fastest show in politics as Vice President Kamala Harris returns to the first in the nation primary state, New Hampshire, today to round out her economic policy proposals with an eye specifically on small business. We'll discuss Harris's plan and talk about new analysis of extending potentially the Trump tax cuts with Bloomberg's Enda Curran. And we'll get the latest on Israel today. Benjamin Netanyahu is preparing to speak this hour, high noon on the East Coast. Gidi Grinstein, former secretary coordinator for the Israeli delegation for negotiations with the PLO, a peacemaker who spent time at the table, is with us ahead. And we'll have analysis from our signature panel. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, with us, as always, for the hour. And we start, as ever, on Wall Street. Let's get up to date on the markets first. Following a brutal day, here's Charlie Pellet in New York.
And the selling continues today, Joe Matthew. Little change, perhaps, is the real story, but in the red on the S&P, down now by a point, down less than 0.1%, just about flat on the day. We got the Dow holding on to a 54-point gain right now, up by about 0.1%, while the NASDAQ Composite Index lower by 7, a drop there of just under 0.1%. 10-year at 3.79%, with a 2-year that's at 3.80%. Gold, little changed, up $1 the ounce to $24.93. West Texas Intermediate crude extending its slide down another 0.8%. WTI right now, $69.82 a barrel. Treasury yields tumbled after data showing a further slowdown in the labor market lifted Wall Street bets on Federal Reserve rate cuts. As for the market backdrop, heading into Friday's jobs report, Stuart Kaiser is head of U.S. equity trading at Citigroup Global Markets.
There is a lot of strong